Inflation concerns, recession risks, and central bank policies push global bonds to their first bear market in a generation. It's US jobs report day. The hotly anticipated data has the potential to tip the scales towards a third jumbo-sized Fed hike this month. And crunch time. EU leaders warn Europe may not be able to avoid energy supply shortages this winter, even as flows look set to resume through the Nord Stream pipeline. Good morning, everybody. Let's have a look at the futures picture then. Just 20 seconds or so to go until the start of the European equity trading day. And the futures picture looks pretty positive, bearing in mind yesterday that we closed the European session in negative territory, quite firmly so. US markets ended the day a little more mixed, a little flatter. And so as a result, perhaps we need to play a little bit of catch up, turning the tide on what has been days of negativity here in Europe. Then the futures certainly suggesting we will go higher. So we'll wait for the FTSE 100 to open up, but we are expecting then markets to drift a little bit higher. How long they'll stay there, we'll see. We've got a fairly flat picture coming through from US futures, and of course the jobs report still sits ahead of us into the early afternoon European time. So the Spanish IBEX up by 0.5%, the FTSE 100 up by around 0.5%. With the FTSE in mind, we'll keep an eye on some of those oil names, given a slight rebound in oil prices. The euro is stronger. That's in keeping with a more risk-on tone that we're seeing here for European markets at the start of Friday's trading session. The dollar has been really strong, of course, record highs on the dollar index in yesterday's session. Today, we take a bit of a breather from that money going into stocks, coming out of some of those havens like the dollar, and the euro gains as a result, up by 0.3%. On sovereign bond markets, of course, a big focus on this bear market that we are now in. The Bloomberg measure of that suggesting we're in a bear market for the first time in a generation. So that's certainly a focus for us. Today, we see buying at the Australian 10-year, the Spanish 30-year, the Italian 10-year, a mixed bag there, and some of those yields coming lower. This is the commodities picture, and we mentioned in our headlines what's going on with energy prices in Europe, or what's expected to happen with the Nord Stream pipeline. And according to some of the flow data that Bloomberg has seen, it does look as if that pipe is going to be active again from Saturday, and that is supposed to be the case. That is supposed to be the end of the maintenance period for Nord Stream 1. So we'll see if that comes to pass, and crucially, at what levels do those flows resume? So natural gas prices dropping once again a little bit on that. Let's move on to a broader asset check, pick up on some of those same themes I've mentioned, and just get you some numbers. S&P futures then, this is the more muted picture we have on the US futures picture. You'd expect that, I suppose, on jobs day. And this is where we are on the US 10-year yield, 3.23%, still very much inverted there. What is this bear market in bonds now telling us about where the US economy goes, about expectations of the investment community for returns in the future? This is the dollar index. We're at, we were at record highs, as I mentioned, just dropping a little from those record highs in today's session. And this is Brent crude at $94 a barrel, up by 1.8%, but it has been a troubled week for oil prices. Let us get to our Bloomberg Markets Live managing editor, Mark Cudmore, who joins us, as usual, this hour to take us through one of the charts that has caught his eye. Mark, good morning once again. So you're looking at the yen and ongoing expectations of yen weakness.
Indeed, Anna, yen was really the focus of the Asia session. People got quite excited by that arbitrary level of 140. So I thought I'd kind of do a chart to show that this is the cheapest it's been to be negative the yen in 21 years. Let me explain that at the moment. So this is a chart of 1 year dollar yen forward points. They are the most negative. This means that if you buy dollar yen spot now and roll it out 1 year forward, your contract in 1 year's time is 580 pips below the spot level today. That's about 4.5%, i.e. if spot doesn't move from today until 1 year's time, you'll just earn 4.5% for the difference of the forward price to spot. And that's what you're getting paid to be long dollar yen. So anyone who kind of goes, oh, dollar yen's gone too far, you know, surely this is a bit stretched. Well, look, it's getting cheaper and cheaper to short the yen. And remember, the reasons for being short the yen haven't changed. You've got a bank here that's keeping an extraordinary easy monetary policy as the rest of the world is hiking rates aggressively. They're a massive commodities energy importer in a world that's having an energy crisis, and they have still much worse growth than much of the rest of the world. So everything is still extremely negative for yen, and we haven't reached that breaking point yet. So I think, unfortunately, yen is going to have much more downside over the next 6 months, and we might get some quite funny moves, especially as it gets cheaper and cheaper to do so as the Fed raises rates and the BOJ doesn't.
Really interesting. So those interest rate differentials continue to be felt by markets. Mark, thank you very much for that. Bloomberg's Markets Live Managing Editor, Mark Cudmore. Now we're joined by Claudia Panzeri, Head of Equity Strategy at UBS, and Christine Aquino joins us here at Bloomberg from our markets team. Thank you both for coming to speak to us. Claudia, I'll come to you first. I know that equity strategy is clearly your specialism. That's where we want to linger. That's where we want to spend much of our conversation. But I just thought I'd get your reflections on a bond market that now is 20% off its peak, and what that means more broadly for equities, I suppose.
Yeah, adjusted evaluation. Good morning, everyone, and thank you, Anna, for having me today in Bloomberg. I think we changed clearly the regime. We went from very low level of interest rate with inflated price earning, especially on stocks and sector which are growth tilt with a long duration, to a devaluation, a depreciation of this segment which are negatively correlated with real rates. So clearly is interesting to see how this bond rise in the bond yield had impacted growth stocks which have benefited from below level, but also the overall US market, which has seen probably one of the biggest derating when we look into the PE.
Okay, so that's the read-through, isn't it? The higher yield environment weighing on growth stocks. We'll be back to that theme in a moment. Christine, good morning to you. Your reflections on where we are. I mean, I was reading about how, you know, the 60-40 portfolio has been threatened because we're talking here about a bond bear market, but August was tough for all kinds of asset classes, wasn't it? I mean, it's difficult to know where to look for returns at this point.
Absolutely, Anna. And I think this is going to be the issue again for investors heading into the last few months of this year, right? If we are seeing these sorts of moves in bond markets and equity markets are also getting challenged, really, where is there left to hide, right? And I think it's going to be interesting, though, heading into the next couple of months when we get more of a sense of where central banks are going to go in terms of their policy tightening process. I mean, there's always this question of when does the rotation kick in when investors start seeing value in bonds again, because we are getting to these high levels. And you would think if the expectation is that Federal Reserve tightening and central bank tightening in general will eventually push us into recession, well, these are probably good levels for bonds to get into at the moment. But of course, timing is everything, as always, and investors definitely fretting about that.
Yeah, exactly. And so when we get to some of those key levels on the 2-year, on the 10-year, then some people talking about money coming back in. Claudia, as we look towards the end of the year, thinking about your equity universe, we've talked about how growth stocks have been challenged by the higher rate environment. So how do you want to set up a portfolio then if you're nervous about higher rates and weaker growth stocks?
Yeah, we have been very concerned already about the rise in bond yield, but also about the gap in earnings growth between value and growth names. So we are positioned for having a portfolio which has a value tilt. This is already since last year. But also we introduced a more defensive position back in February, and also re-added some defensive the last month with increasing consumer staple exposure in our global sector allocation and US allocation. So clearly what we are tilt is a value plus quality, income quality as well, but also defensive sectors such as healthcare and consumer staples. We are very still long energy and energy sector. This has been one of our best calls since the last year. Despite the Brent is volatile, we continue to think that the energy stock are pretty cheap, free cash flow yield is very high, and dividend and share buyback will continue to support the stocks.
Okay, I definitely want to return to the energy theme with a sort of European bent a little bit later, Claudia. Can I just linger on something in the US, which of course is going to be on the agenda today, which is the jobs report. How are you preparing to look at this jobs data from an overall equities perspective? Yesterday we saw some news around jobs, and it seems that, well, I saw it described that good news is bad news, but bad news is bad news. So pretty much everything is bad news for risk assets at this point. Does it feel that way?
Yeah, I think this is the reason why we continue to increase the defensiveness of our portfolio, at least within the equity space. Clearly, two-day data is quite important. I think the Fed is not only looking to one point. The Fed is watching the job market, price paid, inflation, and so on. So I think the risk of having another additional 75 basis point hike is high, and also to have a big rally on the real rate. So I think keeping this value exposure and consumer staple, healthcare, or other defensive sector is quite important, because as you mentioned, good news is negative news, and negative news can be negative news. So the volatility on the equity market will remain quite high as long as the picture on inflation will be more clear than it is right now.
Yeah. Seems a gloomy conversation for a Friday, but there we are. That's where we find ourselves. Christine, what is at stake for you when you look at these markets when it comes to the jobs report later? We're expecting a substantial increase, a substantial number still in job creation, maybe not what the Fed wants to see, but it might be moderated versus the prior month. That's at least what the estimates show.
Absolutely, Anna. And I think really this will probably amount to just reinforcing the fact that the Fed does have room to keep going. Whether they go 75 or 50 basis points next month, of course, is of interest to markets. But generally, we know the direction of travel, right, as far as the indication from Jay Powell and the rest of his colleagues from Jackson Hole over the past weekend. So it really is, you know, this regime of tightening policy. And it's kind of interesting how that is flowing through to our region as well, because, of course, 75 basis points very much on the table as well for the ECB now, and potentially the BOE in later in September. But again, you know, this idea that really central banks are going to be pushing into those bigger rate hikes potentially, or at least that's the expectation. It's going to be interesting September to see if they all deliver on that.
Yeah, we still seem to be stuck in jumbo territory, don't we? And some of them, some yet to start, but still there. Claudia, let me come back to you on the earnings story and equities. I spoke to a guest from Morgan Stanley this week and also from Barclays, both of whom were making the point that stocks have fallen a lot this year. I think we're thinking here more about the US. Stocks have fallen a lot based on changing interest rate expectations, but not really because of downgrades to growth estimates, and that latter point needs to catch up with reality. Is that a view that you share?
Yeah, I think we still expect more downgrades to come and earnings growth to be revised down by the end of the year. But I think the earnings revision are always very late versus the market pricing. So we still expect a lot of downgrades. We have EPS growth for the overall market for US, which is well below consensus. But this is something that people, investors are aware of. So when I look, for instance, what the global market is pricing, is already pricing negative EPS growth. I think the earnings season will add some volatility, but I think it's not what will make the market change in direction. What really make the market change in direction is when the Fed will stop hiking, and then when we will see that growth will be weak. So with weaker growth, lower bond yield, and US probably moving into a major slowdown, the market will start to move higher because of rates, not because of earnings.
Okay, we'll be back to that pivot conversation then, it seems, even if the Fed doesn't want us to have that just yet. Claudia, thank you very much for that. Thanks to Christina Aquino from Bloomberg. Thanks to Claudia Panseri, Head of Equity Strategy at UBS. Claudia stays with us a little bit longer on the programme. Coming up here on this programme, Britain will have a new Prime Minister on Monday, and whoever enters number 10 will have a very full in-tray. More on the leadership race next. This is Bloomberg.
Last month's jobs report caught everyone off guard.
This is quite a surprise. Oh my, as Dick Enberg would say.
That is a wow statistic.
That recession talk just got a freezing cold shower.
Today, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
It's good news, bad news, good news.
They're walking that fine line.
We still have a large gap between jobs and workers, but at least we're moving in the right direction.
The market has 2023 wrong.
The August jobs report today on Bloomberg Television and Radio.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then betray you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci is really teetering on the brink at this stage.
To be able to give our customers vehicles, that are their primary vehicles that are EVs, and to be able to do that, we need to have range and infrastructure, and we need to remove the pain points, and so that's what we're doing.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Welcome back to the European Market Open, and 15 minutes into our trading day, this is the picture across European equities. Playing catch up a little bit with stateside yesterday. We are up by 0.5% on the Stocks Europe 600. US futures look a lot more negative, actually down by 0.2%. Now, let's talk UK politics. Britain will have a new Prime Minister on Monday, and bookmakers and opinion polls point to a victory for Foreign Secretary Liz Truss, beating her rival, former Chancellor Rishi Sunak. We will see whether that comes to pass, but whoever enters number 10 will have a very full in-tray. We've talked many times about some of the challenges facing the UK economy. Let's bring those together. Bloomberg's Lizzie Burden joins me now on set with a rundown. And Lizzie, give us a sense then of the economic challenges that face the next Prime Minister.
Well, to put it in historical perspective, it's worse than what Theresa May inherited post-Brexit. It's worse than David Cameron got post-financial crisis. You actually have to go all the way back to the early 70s to the oil shock, the miners' strike, for a historical comparison, because you've got double-digit inflation in the UK. Goldman says it could hit 22% next year. It's driven by this energy crisis, and there's a warning from energy bosses that more than half of UK households could face energy poverty. And so people are asking for higher wages. Because there are labour market shortages, it means that they have some bargaining power, but they're not feeling the benefits of pay rises because inflation's swallowing them up. And so the Bank of England's responding with rate rises, which they could rise above above 4%. And that's going to be painful for people who thought they'd locked in rock bottom rates during the pandemic. And so altogether, the Resolution Foundation said yesterday that this could be the biggest squeeze in living standards in a century. And the BOE thinks that a recession is on the way, seeing 2 years of either negative or zero economic growth.
Yeah, so a lot of challenges then facing, a lot of economic challenges facing the new Prime Minister. So if Liz Truss is successful, what do we know about Trussonomics, her economic agenda?
Well, all the way through the campaign, she's expressed that she prefers tax cuts over what she calls handouts, although she has rode back on that a bit and acknowledged the need for some direct support. Of course, when Rishi Sunak was Chancellor, the IMF blamed his premature fiscal consolidation for some of the recession risks in the UK. Truss says that her tax cuts would stimulate growth. But Sunak says, and remember, he's still in the race, he says that all this borrowing that would be needed would mean that the UK could no longer rely on the kindness of strangers to fund its debt. And we had Charlie Bean on Bloomberg TV, the former Deputy Governor of the Bank of England, saying that it could mean there's a crisis for gilts and sterling. And if you look at the pound, it's performed worse than 132 of 150 top world currencies since Boris Johnson's resignation. So markets are reacting. And the other big worrying thing for markets is Truss trying to take on what she calls the blob, the economic orthodoxy at the Treasury and the BOE. She blames the BOE for inflation and wants to change its mandate. So all of these policies, not really radical in isolation, but when you put them together, you can see the concern in markets.
Okay, Lizzie, thanks very much for the rundown. Lizzie Burden here at Bloomberg with an update on the UK political story. Let's get a focus on markets then with all of that in mind. Claudia Panseri still with us, Head of Equity Strategy at UBS. Claudia, let me ask you about UK assets then. And you talked about a preference for UK assets earlier on, or specifically UK stocks. And I suppose here you mean UK listed ones with not too much exposure to the domestic. Yeah, so tell me about which of the stocks you favour.
Yeah, exactly. I think UK, I know that lots of people are questioning why we are positive on UK stocks. And I think one of the reasons is because it's one of the most international markets. Please remember that most of the UK names are reporting in dollars. So a weaker pound is clearly positive for UK names and especially for the FTSE 100. I'm not speaking about the FTSE 250, which is not benefiting from the depreciation of the currency and is more related to internal consumption. We like the FTSE 100 for different reasons. One is exposed to energy. Energy stocks are on the top of our allocation, but also healthcare and consumer staples. So the UK market clearly, the breakdown in the sector fully reflect what we like across sector globally, but also in UK. Healthcare, consumer staple, energy. The valuation is extremely cheap, still trading at 40% discount on the 12-month forward PE versus the world. Is a country where we don't have growth segment, we don't have tech, and we don't like growth. So clearly reflected or as well our style. I know that this weak currency could be an issue, but with the edge, the FTSE is really attractive.
Okay, so that's the explanation for why the FTSE and not the FTSE 250. Let me ask you about real estate, and this is either Europe or, either the UK or more broadly. What do you think about real estate? I saw that another bank was reducing its expectations on UK house builders. It's not difficult to build a negative case around real estate with rates on the rise.
Yeah, exactly. This is listed real estate, so clearly is a small sector across the world. Is only 2.6% of the index. Is not direct investment in real estate. Is mostly the negative on continental Europe, Eurozone plus UK as well, because of the level of debt of this company, the rising rates, but also after the rally during the summer, more at the global level than in Europe. The sector is one of the defensive sector which the expensive valuation discount to the NAV has been reducing quite a lot, but also this negative correlation with rates. So considering that a lot of people believe that listed real estate is an edge to inflation, in reality, if you have inflation by rising rate and lower consumer, the sector should be impacted negatively. So this is why we have this preference for consumer staple versus real estates.
Claudia, thanks very much. Thank you very much, Claudia Panseri, joining us there with the latest thoughts on European equity markets, Head of Equity Strategy at UBS. Thank you very much. Coming up on the program, the Fed's Raphael Bostic says the US Central Bank's campaign to cool inflation is far from complete, with all eyes focusing on the hotly anticipated US jobs report. We hear further hawkish thoughts from Fed officials. This is Bloomberg.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy in 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
Yes, it's about renewables.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight, with replays all weekend on Bloomberg Television and Radio.
Welcome back to the European Market Open. 25 minutes into what is, for now, a positive session for European equity markets. We're up by 0.7% on the Stoxx 600. Let's get a Bloomberg Business Flash. Top corporate stories we're covering this morning. Here's Alice Atkins. Good morning, Alice.
Morning, Anna. The arrest of Glenpoint Capital co-founder Neil Phillips for alleged foreign exchange market manipulation is threatening to ripple across the hedge fund industry. Another firm has now suspended staff who previously worked with him. Phillips, who is associated with some of the biggest names in the hedge fund world, was arrested in Spain at the request of the United States. Shell is reported to have shortlisted candidates to succeed Ben van Beurden, who is preparing to step down in 2023. According to Reuters, a number of internal picks are being considered. Van Beurden will leave after almost a decade as CEO. Credit Suisse is reporting to be weighing 4,000 job losses as it overhauls its business after a series of financial and reputational scandals. German newspaper Handelsblatt says the figure does not include cuts in investment banking. Executives are currently meeting in Singapore to discuss the company's strategy. That's your Bloomberg Business Flash. Anna?
Thanks very much. Thank you to Alice Atkins for an update on the corporate news that we're following. Coming up on this program, recession risk rises. The energy situation in Europe is in focus. We'll discuss all the risks with our guest, Ludovic Subran, next. He has some interesting suggestions of his own about how caps on energy prices should work, about how the European economies can try to weather all of the challenges that they face going into the winter. And we've had some interesting reporting here at Bloomberg around whether flows will return to Nord Stream 1 over the weekend. We'll get an update. This is Bloomberg.
floating flowers are made of 92,000 solar panels. Laid on the surface of a reservoir, they can generate 41 megawatts, which is enough to power 20,000 homes. It's one of the biggest floating solar plants in the world. Floating solar arrays have been gaining traction in Asia, including countries like Singapore and Thailand. Floating projects typically benefit from an easier connection to the power grid. They can also restrict algae blooms while keeping the solar panels cool. This one in particular has helped the local economy. When the power plant was first proposed, residents were given the chance to invest. Some locals were also offered jobs during construction. In fact, it was the community that requested the panels to be shaped as flowers to look more appealing. South Korea still relies heavily on imported fossil fuels, but will need to change that to reach its goal of becoming carbon neutral by 2050. Solar plants like this one may help the country reach its net zero goals.
Is moving both Citadel and Citadel Securities to Miami. The scoop was broken by Bloomberg's Amanda Gordon.
Welcome back to the European Market Open. 30 minutes into your European trading day. Here are your top stories. Bearing the burden, inflation concerns, recession risks, and central bank policies push global bonds to their first bear market in a generation. It's US jobs report day. The hotly anticipated data has the potential to tip the scales towards a third jumbo-sized Fed hike this month. And crunch time, EU leaders warn Europe may not be able to avoid energy supply shortages this winter, even as flows look set to resume through the Nord Stream pipeline. Let's have a look at where we are on the markets then for you. This is the picture, the big picture. Stocks Europe 600 up by 0.7%. The DAX and the FTSE also making some gains. Keep in mind, though, we've got the jobs report due out later, and often that leaves us in limbo as we wait for that. And the US equity markets give us a bit more sense of that limbo, flat to negative on US futures. And we closed in negative territory yesterday here in Europe, where the US markets managed to eke out some gains in places. And so, as a result, a little bit of catch up. Really interesting to look at the sector breakdown, though, because it tells some interesting stories about what's going on around the world. We've got utilities moving lower, down by 0.1%. Some of those prices coming down, continue to come down. Gas prices coming lower. And we've talked about this over recent days around storage levels in Europe looking more positive, around what European leadership can do to try and cap prices. More on that in a moment. But our latest reporting also suggesting that that flow will return on Saturday. We just don't know how much, of course, and for how long. That's still a risk hanging over European economies. Basic resource stocks also under pressure. Again, that's interesting in the context of China and fears around slowdown in the Chinese economy, further slowdown, I should say, given the COVID fight is ongoing there. And we've seen iron ore prices affected as a result. And so basic resource stocks move a little bit lower. Technology is rebounding today after some of the losses of late. So we're up by 1.4%. But also we got some positive mood music from Broadcom overnight in the US. And so that's lifting some in that chip space. And I'm looking for consumer products and services sort of in the middle of the pack there, up by 0.6%. But that includes the likes of Puma and Adidas and some other businesses that are really managing to move higher on the back of some positive messaging coming through from Lululemon over in the US. Let us get a Bloomberg First Word News update. Alice Atkins has that for us. Alice.
Hi, Anna. President Biden has accused Donald Trump and so-called MAGA Republicans of assaulting the foundations of U.S. democracy. In a primetime TV address, he urged Americans to reject any candidate backed by his predecessor in the November midterm elections, labeling them extremists.
Donald Trump and the MAGA Republicans represent an extremism that threatens the very foundations of our republic.
The company that runs the Zaporizhzhia nuclear power plant in Ukraine says a team of UN inspectors will remain there until Saturday. It's the first time in the IAEA's 65-year history that monitors have crossed an active battlefront in order to carry out an inspection. Supermarket shelves were emptied and anxious motorists filled the roads trying to get home in the hours before Chengdu's 21 million residents were put into a strict lockdown. It's the fourth Chinese megacity to be locked down so far this year as Beijing pursues its COVID-0 policy. Local officials have given no information on when the lockdown will lift. And employers in the UK stepped up recruitment last week in preparation for a rush at Christmas. The Recruitment and Employment Confederation says around 2 million new jobs were advertised, the highest figure for 2022 and the second highest on record. The figures suggest labour shortages will continue to be a problem for businesses. Global news 24 hours a day, on air and on Bloomberg's Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna?
Alice, thanks very much. Alice Atkins here in London. Now, economists are slashing global growth forecasts for both this year and 2023. Meanwhile, forecasts on the likelihood of a recession in global markets have shot up. Joining us now is Ludovic Subran, chief economist at Allianz. What we're showing here also on a chart, Ludovic, is that based on medium probability projections of private economists, it seems that a recession in the Eurozone and in the UK, in fact, is now the base case. Do you have a base case assumption for recession in the Eurozone?
Yes, hi, and I think we do have, unfortunately, the assumption of a recession in the Eurozone. We already see a technical recession in the manufacturing, trade-driven countries such as Germany. And you know, the summer has been good for the service-led economies such as Spain and France. But, you know, it's like the ant and the grasshopper story. We really feel that as real income growth is really faltering, people will start to be less into consumption. And we already see this gap between nominal and real consumption in many countries in Europe. So I'm a bit worried that at the turn of 22, we have what resembles really a flat growth or borderline recession. The question is whether it's shallow and manageable or whether we are actually reconnecting with our demons of the past and not being able, for example, to have a collective approach to the gas crisis, to the energy crisis, because that could plunge us in a much deeper recession that could last all the way into half of 2023.
Right, okay, so we'll see how those demons of the past surface on September 9th or don't, and that's when we have a meeting to think about these things, to think about energy policy at the European Union level. Thinking about that then, Ludovic, I know you've done a lot of thinking about how European policymakers can try to make things better here. I spoke to one guest yesterday who said we shouldn't have a price cap because we need the price signal that the high energy prices produce. I spoke to another guest who said, no, we do need a price cap because if you cap it at not even very high levels, but elevated levels, you'll still get the price signal. What is your expectation on price caps?
I think price caps are very costly and actually are not very market friendly. So when you remove price caps, you usually have a lot of deformation. You know, history is really good on teaching us this. So I prefer to try to find ways to really go after those people that really need social transfer to offset the cost of energy, those people that are really falling into energy poverty. You know, over the past months, we've seen governments spend a huge amount of money on price caps, on blanket subsidies, when they could have targeted much better to make financial, the financing of these measures much more sustainable. Now, you know, the crisis is on for more than 6 months. It's going to be on for certainly a few more months than this. So we really need to start thinking about dual pricing mechanisms, whereby you allot a certain amount of energy consumption to people at a certain price, and then the rest is price, market price related maybe. And even we have, this proposal to maybe create an energy savings account for people so that they can take that money for their consumption, but they can already see that if they save some of this can be used for other needs, right? So an idea to incentivize some form of sobriety while making sure you redistribute to the poorest and you help those low-income families. Right now, too much of the public money is going to people who have savings.
Okay, so a dual pricing scheme is one of your ideas. This new social contract, energy money and an energy savings account is another one of your ideas. What do you think will be able to deliver most quickly on a sort of pan-European basis, because countries differ, of course, in the way they function right now in energy markets? What will be the quickest solution that will allow Europe to weather the storm?
Well, the quickest solution is for sure a form of an exceptional price reform on the electricity sector. As you know, the electricity prices in Europe are indexed on the highest, the most costly source of energy today, gas. And this is something that the Spaniards, but also the French now, and the Italians are really not happy with, because it's very expensive for electricity prices in country, but also wrong incentives for renewables energy production. So I think if the EU were to meet today, they absolutely need to focus on making sure that we lower the price pressure in country, especially because of our own setup of the power market, right? And then the next big thing to do is, to my understanding, is to make sure that we start giving money, social safety nets, to those that are the most in need. This is easy. So the energy savings account defense here.
Those are the easier things. Okay, let's move away from the policy, which, let's face it, will be decided by others, towards more economics and expectations there around the ECB, Ludovic. I was reading that 2/3 of economists in a Bloomberg survey say that the ECB is behind the curve. How far behind do you think the ECB is, and how long will the ECB have to hike before maybe we're talking about a policy pivot there?
You know, the problem is that people are drawing parallels between the US and Europe, which are dramatically wrong, you know. I mean, the ECB, everybody is seeing this jumbo hike, just like, you know, for the ECB in the coming meeting, 75 basis points, just like the US did. But the mix of the reasons behind inflation are very different. So I believe that the ECB has to hike fast and to front load the hikes to curb whatever demand-driven inflation we have in Europe. But look, you know, the reality is that 2/3 of the inflation in Europe is supply-driven, is energy crisis-driven. And so hiking by the ECB won't calm the price at the pump. So I'm, you know, it's great that everybody thinks the central banks are late. I think we should stop berating them and actually offer them some credibility or accompany whatever they're doing. That's why the policy blocks on the other side are so important. So my expectation is, of course, that the ECB will try to hike maybe 75 basis points by the end of the year, so 50 and 25, or maybe even 100 basis points, but that won't solve the problem. We're still going to have 3.5% inflation in 2023 on average. And the big issue here is really to see how, during the recession, the central bank can also help make sure that the credit markets doesn't freeze. And so for me, that's the biggest issue right now, that the recession is really at the corner, really so close that the ECB can do a lot now, but they will be stuck very quickly as of January 2023 or so.
Okay, I mean, could they still be hiking at the same time, providing liquidity to credit markets, Ludovic, or does the hiking stop then?
No, of course, and this is a little bit what we need to rethink. You know, conducting monetary policy in an environment of scarcity and of negative supply shocks is really different from conducting monetary policy when you just have to curb wage price spirals and overheating, right? So I think the ECB will have to have a form of cognitive dissonance with liquidity provision mechanisms on one side and maybe higher rates. One thing is sure, the ECB wants to get out of the negative nominal interest rate environment and experience, which was, you know, so highly criticized. But to be fair, the ECB is in charge of the transmission of monetary policy. That's why they have, you know, built these other tools right now to make sure that even if they hike, they don't create financial stress to the level of 2012 in countries like Italy, because we know what the type of cost this could bear for the population in the coming years. Yeah?
Ludovic, thanks very much. Thanks for joining us. Good to speak to you. Ludovic Subran, the Chief Economist at Allianz. Coming up on this programme then, we'll stick with the questions around energy and power problems. The EU sees limits to its interventions in European power markets. That story next. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to the European Market Open. We are 44 minutes into our trading day here in Europe, and European equity markets look like this, up by 0.5% on the Stocks Europe 600. It's jobs day, so we're waiting for that key data point later on in our session. Now let's talk European energy. An emergency intervention in European power markets may lower prices, but it won't protect the region's economy from spillover effects of an historic energy crunch. A policy note seen by Bloomberg says that while the tools can help to mitigate the effect of the crisis, they will not bring energy prices back to pre-crisis levels or remove the significant effects of the crisis on the European economy as a whole. So this note coming from the European Union, from the European Commission, which of course is considering the policy moves that it can put in place. Let's get some more analysis then. Let's bring in to the conversation Anna Shirevskaya, who is our European natural gas reporter. Anna, great to have you with us. So the EU acknowledging there are limits to what it can do, but does it see any short-term solutions at all for the energy crunch?
Yes, Anna, the European Commission is suggesting some short-term measures to try and mitigate this unprecedented energy crisis. But as you mentioned, it's not enough to stop inflation. It's not enough to stop this impact on the economy. And these measures include power demand reduction, including through market incentives and compensation, and price caps on non-gas power generation. That's renewables, nuclear, and coal. And finally, limit on the revenues for power generation, effectively a windfall tax, which could be used to lower bills and provide other support. So these are all the measures that the European Commission is considering at the moment.
Okay, so those are three measures, and we'll look for further progress on this early this month, really, as we see European leaders meet. Europe is ahead of plan in building up its storage of gas, which is the good news, of course, as we head into winter. But German fears are building over potential Nord Stream choke-off. I should say that some of our analysis suggests that Nord Stream 1 will be turned back on Saturday, but then we're just back to where we started. Big questions about whether it gets turned off in the future or what levels those flows come through at. What happens if Nord Stream gas flows are not restored or if they're turned off pretty quickly again?
Yes, at the moment we do see signals that the pipeline will restart on early Saturday after this 3-day maintenance. But the thing is that there is only 1 out of 6 major and 2 small turbines operating on the pipeline. And Gazprom has already indicated that every 1,000 hours, that's roughly every 42 days, that turbine would have to be serviced. So in mid-October, we are gearing up for another shutdown, and you never know what kind of technical malfunction may be discovered. If Gazprom would say that there are some issues with the turbine, it will have to be, then the maintenance will have to be prolonged. So at the moment, unless you have more turbines back in service, this risk of a full shutdown of pipeline during these maintenance activities remains. Yes, so at the moment there is no clarity when turbines are back in service.
Okay, thinking about the policy mix and the policy mix options that lie ahead then, Anna, we've been hearing, of course, from the outgoing British Prime Minister Boris Johnson. He's just announced that the UK is investing in an EDF nuclear plant. Let's listen.
We need to pull our national finger out and get on with Sizewell C. That's why we're putting £700 million into the deal, just part of the £1.7 billion of government funding available for developing a large-scale nuclear project to final investment stage, FID, in this Parliament. And in the course of the next few weeks, I am absolutely confident that it will get over the line.
Okay, so that's the UK story there, Anna, and I saw a line coming through from Handelsblatt this morning in Germany saying that Germany is leaning, according to their reporting, towards extending the lifespan of nuclear plants. It's very important then, I guess, for all of these European countries to be thinking about how they secure future energy supplies, and nuclear seems to be an option.
Indeed, nuclear power is an option at the moment when gas prices are so high and security of supply is an issue. And most of Europe depends on imports of natural gas, and particularly the UK. UK imports gas to a certain degree, and domestic production is declining. So having this additional electricity provider, domestic provider at home, definitely helps for future security of supply, even if they are talking about 2035 when Sizewell C starts. It does help to secure power needs in the future, because you still need a backup for renewables. And as I mentioned, that domestic gas production is on the decline.
Okay, Anna, thanks very much. Thanks to Anna Shirovskaya, our European natural gas reporter. It's going to be a busy few weeks, of course, keeping track of all the policy responses we see in Europe. A headline, across the Bloomberg says that the Swedish Prime Minister adding his voice to the mix, saying the EU must disconnect electricity prices from gas. And I know that Greece has been calling for that. Spain has been active in that conversation. At the moment, these things are lumped together, and there's a lot of calls for separation. Ursula von der Leyen herself has acknowledged a need to do that. So we'll look for the policy response. Coming up, let's go stateside. President Biden ramps up his attacks on his predecessor, Donald Trump, in a rare primetime address on US TV. More on that speech next. This is Bloomberg.
Monday, the UK Conservative Party decides who will succeed Boris Johnson as Prime Minister. As Rishi Sunak and Liz Truss go head-to-head, keep it tuned to Bloomberg for the latest news and up-to-the-minute results. Bloomberg, your global business authority.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
We have to be able to give our customers vehicles
that are their primary vehicles that are EVs. And to be able to do that, we need to have range and infrastructure, and we need to remove the pain points. And so that's what we're doing.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Donald Trump and the MAGA Republicans represent an extremism that threatens the very foundations of our republic. MAGA Republicans have made their choice. They embrace anger. They thrive on chaos. They live not in the light of truth, but in the shadow of lies. More and more talk about violence as an acceptable political tool in this country. It's not. It can never be an acceptable tool. So I want to say this plain and simple. There is no place for political violence in America, period. While the threat to American democracy is real, I want to say as clearly as we can, we are not powerless in the face of these threats. We are not bystanders in this ongoing attack on democracy.
Some of the moments there, some of the highlights from President Biden's primetime TV address. Let's get more on the impact of this and where this leaves us with Bloomberg's Bruce Einhorn, who joins us now. Bruce, great to have you with us. So what did the president have to say? We heard a few clips there. And why was it significant?
Well, Anna, in his speech, President Biden warned about the threats to democracy that he sees coming from parts of the Republican Party. He went out of his way to refer to former President Trump and what he called MAGA Republicans. This is unusual for President Biden, who spent most of his term trying not to talk about Donald Trump. So this is a big change. President Biden contrasted what he called the MAGA Republicans with what he called the mainstream Republicans. He called on mainstream Republicans, Democrats, independents to join together in defending a democracy which he said was under threat.
Okay, interesting approach then, putting former President Trump front and center. With the midterms approaching then, how has the outlook for President Biden changed? I know that the striking down of Roe versus Wade by the Supreme Court has clearly changed some of the dynamics around this midterm.
That's right. It clearly has, and we're seeing that in some of the election results so far. Most recently, there was a special election in Alaska. We just got news about the winner of that election yesterday, and surprisingly, the Democrat won that race, defeating former governor, former Republican vice presidential candidate Sarah Palin. This is a seat that a Democrat had not won in half a century, coming on the heels of special election victory in New York, victory in Kansas, where the right to abortion was on the ballot. Polls are now showing that the Democrats do seem to be gaining more support. A recent poll from the Wall Street Journal found that if people were asked which party did they want to have control of Congress, 47% chose Democrats, 44% chose Republicans. It's a big change from what we were hearing earlier in the year.
Okay, Bruce, thanks very much for the update. Bloomberg's Bruce Einhorn with the latest on U.S. politics. That is it for the European Market Open. Surveillance Early Edition is up next. European equity markets making modest gains, but U.S. futures point a little lower on jobs day. This is Bloomberg.
digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
But look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
The difference between political gossip and policy intelligence. Bloomberg Government provides our clients with expert reporting, analysis, and public affairs tools that give you the edge in reaching policymakers on the Hill. When you're in the business of influence in Washington, information and connections are the currencies on which you rely. For knowledge you can act upon, the difference is Bloomberg Government.
what happens politically and then what the economic fallout is.
I'd be comfortable with some weakness in labor markets if we start to see some job losses. But to be honest, we're far from that today.
We're going into this with an incredibly strong job market. This is not like other situations we've had historically.
We won't be able to get the strong labor market conditions we had in the last expansion unless we get this inflation down.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, in for Francine. Here's what's coming up on today's program. Bearing the burden, inflation concerns, recession risks, and central bank policies push global bonds to their first bear market in a generation. It's U.S. Jobs Day. The hotly anticipated data has the potential to tip the scales towards a third jumbo-sized Fed hike this month. And crunch time, EU leaders warn that Europe may not be able to avoid energy supply shortages this winter, even as flows look set to resume through the Nord Stream pipeline. It's Friday. You made it to the end of the week, and there is some positive risk on moves, but it is ever so slight after a pretty ugly week. U.S. equities able to end the session marginally higher yesterday. They are lower this morning, down about 0.1%. We've seen some of the biggest outflows, according to Bank of America, from global equities in some time. It's been a very difficult period following on from that Fed Jackson Hole meeting. At the same time, yen piercing through versus the dollar, that 140 level, that psychological level. At what point do we start talking Bank of Japan intervention? Perhaps we are a while off that, considering that they do not have the same inflationary problem that the rest of the world does. We're also looking at U.S. 10-year yields. Those are nice and flat this morning. They're hanging around 325. Front end of the curve still around its 2007 high. We are in a global bond bear market. I'll get to that stat in just a moment. Meanwhile, NYMEX crude up 2%. We had seen some declines. Of course, it's trading around 88, which this time last year we were much. Yesterday we're much higher than that, but we do have some talk around the Iran nuclear deal that the U.S. says that the talks aren't constructive at this moment, so perhaps some of that getting priced out of the market at the moment. So yes, U.S. futures are lower, but we are seeing some gains in European stocks. Perhaps it has to do with the pot of session in the U.S. yesterday, or just some consolidation after a tough week. The outperformer this morning is the DAX, up more than 1%. You're looking at the FTSE 100 up about 0.5%, but most of these indexes higher. But again, for the entirety of the week, we are looking at the worst week for global equities since June. Now let's get back to that bond story, because as I said, global bonds, they've slumped into their first bear market in a generation. That's as central banks ramp up an effort to tame inflation, even at the cost of a possible inflation. So there you go. There's the Bloomberg Ag. You can see down from that 2021 peak more than 20%. Well, let's get into markets now. We're joined by our very own Christine Aquino from our Bloomberg's market team and Patrick Armstrong, CIO at Plurimi. Well, thank you both so much for joining today. Christine, let me kick it off with you and just sort of setting the backdrop here. We're down 20% on the bond market. I gotta be honest, I kind of already thought we were there to some degree because it's just been such a bad year for bonds. This most recent leg lower, what's driven it?
Well, I think it is, Danny, the realization that we're back into September, you know, the sort of narrative of, oh, maybe inflation has peaked and equities can rally again and risk can be supported again over the summer. That's very quickly fading, especially after we heard from various central bankers at Jackson Hole. And I think really, whether it's the Fed, whether it's ECB, potentially even the BOE, it seems like 75 basis points is kind of the new number that's being tossed around as really what central bankers have to deliver. And therefore, the move in bonds has really kind of came back swinging after a bit of a benign summer, really, as this kind of realization that, oh yes, they're going to have to do more. We're going to have to see yields much higher from here settles in.
Yeah, Patrick, so I mean, we're back to the downtrend, right? We're back after that pause. To what degree is this a sustained trend, that it is a new secular bond bear market?
I do think the longer duration bonds have further to fall. I think the shorter duration bonds have all the Fed's moves priced in pretty much now. The ECB is pricing in 75 basis, or market's pricing in 75 from the ECB now. So I think all the near-term stuff central banks are going to be doing is reflected in the front end. But inflation, I think, is going to be persistent. You've not really seen a change from governments. They're still running big deficits. You've seen monetary policy get to the point where it's neutral. Even today, it's still stimulative where the Fed is today.
Right.
So Powell alluded, he said, we may be at neutral, but they're not. 75 basis points gets them to what plausibly can be neutral. So we're getting to the point where we're stopping inflationary pressures rising, not curtailing them yet.
So if it is all priced into the front end of the curve, what does that mean for your cross-asset allocation? Because I have seen that used as an excuse. Okay, maybe it's okay to dip back into equities. You know, maybe some of these other currencies, not the strong dollar, might be attractive. Does it change anything for you?
I think dollar is going to continue to strengthen. That'll reflect that the Fed will continue to be more hawkish than other central banks. I think the ECB will want to get 75 basis points in, and then their window closes. I think Europe's in a recession right now. They'll be able to get 75 in, but after that, it's going to become more and more problematic for them to do. And if you look at interest rate futures, it's got the ECB hiking in 2023 while the Fed's cutting. No way that happens.
Yeah, I want to get into that dichotomy, but I mean, first, Christine, to Patrick's point, we are pricing in cuts for next year. I want to get both your take on this, whether it's going to be the market needs to price out Fed cuts next year and say we're going to keep going, or whether it's the ECB that's going to be cutting once we eventually get a recession. What does it seem that folks are saying is the most mispriced at this moment, Christine?
Well, I feel like it's the latter, Danny. I think it really is just the market's kind of, you know, I think we have to remember the ECB is a little bit behind, or a lot of it behind from the Fed in terms of its tightening cycle, and that's why markets haven't really kind of digested the possibility of cuts. But to Patrick's point, you know, Europe is in a recession. We have an energy crisis looming. It's going to be a very challenged environment. I think it really is just markets kind of haven't gotten to that point beyond the rate hikes to start thinking about cuts. But it's only inevitable, I think, down the road.
I see that, but you know, Paul, I also got to say, if I can challenge you a bit, Christine, I don't know, Paul, whether you, Patrick, you'd agree with me or not, but Patrick, isn't there some degree to which the market pricing in cuts next year for the Fed just doesn't make sense?
It's too cute, I think. While the Fed's hiking to pricing in a cut, it would mean the market knows exactly what the outcome of the Fed's policy is going to be, while the Fed doesn't. And I think that's probably a bit arrogant for markets to say. I think the Fed's always made the mistake where they've hiked too far and then quickly had to cut because they provoked a recession.
Yeah.
The Fed policy members now know about that, and they're going to be adjusting their policy accordingly.
Christine?
Well, I think this is why we have the don't fight the Fed adage, right?
Yeah.
But this is kind of the history of markets versus central banks, right? Kind of markets really over-egging one direction or another in terms of policy, and then they actually see the central bank response as a bit more measured. And it has to be a bit more measured because it's not just kind of one thing that they're considering. It's the impact of these policy actions on markets and the broader economy, which is really what matters to them. And then markets have to adjust. And so I think this is really just kind of this push and pull process. What I will have to say is that markets have kind of, I think, successfully kind of pushed the Fed and central banks into thinking about this policy shift. Because, you know, again, we saw markets kind of pricing for this tightening shift as early as around this time last year, when, you know, it wasn't quite a certainty that we were going to see this big shift in policy for the Fed and really a lot of central banks. So there is something to be said about kind of markets thinking forward in that. But of course, the impact of policy, another discussion altogether.
Okay, Christine, your time in the hot seat is up. We'll let you go from here. Christine Aquino from our markets team. Patrick, you're sticking around. Patrick Armstrong, CIO at Plurimi Wealth. Now, coming up, Britain will have a new prime minister on Monday, and whoever enters number 10 will have a very full agenda. More on the leadership race next. This is Bloomberg.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then betray you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our targets.
Spare capacity is becoming scarce. We are running on thin ice.
No one deliberately wants to go into battle, but we sleepwalk into conflict.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, the UK will have a new prime minister on Monday, and bookmakers and opinion polls point to a victory for Foreign Secretary Liz Truss, beating her rival, former Chancellor Rishi Sunak. Now, whoever enters number 10, though, will have a very full agenda. Joining us now is Bloomberg's Lizzie Burden. Patrick Armstrong, CIO at Plurimi Wealth, is still with us. So, Lizzie, let's start with the economic picture, the backdrop that the new prime minister will face. What does the set of challenges look like?
Very full in trade. So you've got double-digit inflation in the UK. Goldman Sachs has said that it could go above 22%. It's driven by the energy crisis, of course. You've got more than households facing potential fuel poverty. The Bank of England responding with rate rises back to back, could go up to 4.25%. You've got the labour shortages leading to bargaining power for workers, demanding higher wages, strike action across the country. Put it all together, and the Bank of England sees recession risks, growth, negative growth, slowdown, stagnation for 2 years.
And I feel like this is part of the thing when it comes, I mean, I guess this is a Europe issue as well, that the BOE can only do so much when it comes to the energy crisis, that to some degree we're looking to fiscal policy to see what they will do. I mean, from what you've heard, Patrick, in terms of fiscal policy, does it change at all the calculus for what sort of political risk should be priced into UK assets right now?
The fiscal response so far has been a bit of populism, basically promising that I'll do quick tax cuts, or if it's Liz Truss promising she's going to solve something with Northern Ireland and maybe triggering Article 16, things like that. So I think she's going to try for a big near-term win.
Yeah.
I don't know if it'll be a long-term strategic plan, but she'll want to get that quick win under her belt, assuming it is Liz Truss on Monday.
Yeah, I mean, to that point, Lizzie, what is sort of like the economic worldview of Liz Truss?
Well, she's expressed her preference for tax cuts over handouts, as she calls them, the whole way through the campaign. But it does look like that campaign economics could change into a bit more government realistic economics when she joins. The whole point of the emphasis on tax cuts, though, is that she says it would stimulate economic growth. The IMF had said that Rishi Sunak's tax rises were part of the recession risk in the UK. But she also, the big other thing in Trussonomics is that she wants to take on what she calls the blob, the Treasury and the BOE, the economic orthodoxy there. And part of that is changing the BOE's mandate, or at least reviewing it. And so that's been worrying for market watchers.
Are you worried about that, a change to the BOE's mandate?
I think it's going to happen over the next decade that we get more comfortable with inflation that's persistently above 2, and 2's not the targets, and it drifts to maybe 4 or around 2. Things like that have already happened, that it used to be below 2 and then to an average of 2. And populism's the winning model in governments. When you're spending more than you're taking in revenues, it's going to create inflationary pressures. And I think populism isn't about to change, well, in the next few years.
I was going to say, just looking at sort of your positioning, it's not one necessarily, Patrick, that elicits, optimism about the UK economy. I see that you're short some of these property companies. Talk me through your thinking.
Well, you've got rising interest rates, growing credit spreads, and their funding costs are really going up. You've got companies reassessing models where there were 3 days in the office, 2 days from home, hot desking, you need less office space. All of those things mean you're not going to get rental increases, you're facing higher yields, lower capital values. So I think shorting property companies in the UK makes good sense.
Yeah, and Lizzie, I feel like we have been talking a lot about this week about a UK housing crisis, issues in the property market. How much do we know about what Liz Truss, her team, what people have or haven't said about what they plan to do to tackle it?
Well, at this stage where the two candidates are appealing to the grassroots Tories, the Tory membership, the ballot closes at 5 p.m. tonight, they're having to preach to an audience that doesn't necessarily want more homes in their back gardens. So Rishi Sunak said that he won't build on the green field. Liz Truss has not committed to this 300,000 a year new homes target that the government currently has. And so if they don't come out with more policies to build more homes, when whoever takes power does, then that shortage could continue to boost house prices. We had more data from Nationwide yesterday. We're not really seeing the major housing market slowdown that analysts, policymakers at the BOE have been warning about for a long time. But there is this slowdown in buyer demand, which usually portends a slowdown in prices.
Right, and Patrick, I mean, we were talking before sort of this dynamic, this mispricing between the Fed and the ECB. Talk to me about, I know in the break we were talking about sterling euro dynamics, the dynamic and what the market consequences of that will be between the ECB and the BOE and the set of challenges they face.
They're both facing incredible challenges.
Yeah.
Stagflation is the toughest environment for central banks because you've got higher prices, slowing growth. Whatever you do is going to magnify one and hurt the other one. And they're in no-win situations. They're not going to get inflation down without provoking recessions. We're already in recession in both those regions, but they've got to hike because inflation's still growing in Europe, still growing in the United Kingdom because of the weak currencies, where I think it's probably plateaued in the United States.
Okay, Patrick, thank you so much for joining us this morning. That's Patrick Armstrong, CIO at Plurimi Wealth, and also our very own Lizzie Burden. And of course, stay tuned. Monday, we're going to have the conclusion of Britain's leadership race right here, coverage of that on Bloomberg TV and radio. We're going to bring you a special starting at noon London time. Let's now get to the Bloomberg First Word News. With that is Leanne Gerrans. Leanne.
Good morning, Danny. President Joe Biden has accused Donald Trump and so-called MAGA Republicans of assaulting the foundations of U.S. democracy. In a primetime TV address, he urged Americans to reject any candidate backed by his predecessor in the November midterm elections, labeling them extremists.
MAGA Republicans represent an extremism that threatens the very foundations of our republic.
Now, the company that runs the Zaporizhzhia nuclear power plant in Ukraine says a team of UN inspectors will remain there until Saturday. It's the first time in the IAEA 65-year history that monitors have crossed an active battlefront in order to carry out an inspection. Now, supermarket shelves were emptied and anxious motorists filled the roads trying to get home in the hours before Chengdu's 21 million residents were put into a strict lockdown. It's the fourth Chinese megacity to be locked down so far this year as Beijing pursues its COVID-0 policy. Local officials have given no information on when that lockdown will actually lift. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Danny.
Leanne, thanks so much. Coming up on the program, Credit Suisse is reported to be weighing 4,000 job cuts as it works on its latest overhaul plan. We'll get you that next. This is Bloomberg.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you would be.
Last month's jobs report caught everyone off guard.
This is quite a surprise. Oh my, as Dick Enberg would say.
That is a wow statistic.
That recession talk just got a freezing cold shower.
Today, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
It's good news, bad news, good news.
They're walking that fine line.
We still have a large gap between jobs and workers, but at least we're moving in the right direction.
The market has 2023 wrong.
The August jobs report today on Bloomberg Television and Radio.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. According to Germany's Handelsblatt newspaper, Credit Suisse is weighing 4,000 cuts. This as the lender overhauls its business after a series of financial and reputational scandals. For more on this, we're joined by Bloomberg's European finance reporter, Nick Comfort. So, Nick, a lot of numbers floating around out there about what potential job cuts we might see. But if I was an employee at Credit Suisse, what should I be expecting?
Yeah, I think numbers at this stage are probably speculative, as the bank would put it. But I mean, or as a reporter, I'd say they're not final numbers, so we shouldn't get too wedded to the numbers. We at Bloomberg reported that job cuts could be in the thousands. So for people at Credit Suisse, I think it's probably a question of thinking, what division do I work in? Is this an area which the bank still wants to remain in? Is this an area also where the bank will be focusing its cost cuts? That's probably a key question. If sitting in Switzerland, I'd say the employees are probably in the business side of things are probably safer. In the wealth management divisions are probably safer. But the investment bank, that's definitely an area where, depending on the division, the bank may want to be exiting the business which these people are working in.
And of course, you know, what we have heard from Credit Suisse, basically saying, hey, wait for our next results, then we'll give a strategic update. What should we be expecting?
Well, they give us a pretty good hint with their second quarter earnings. They said they want to be they focus their investment banking on advisory and capital light businesses. So basically things that complement their wealth management franchise. They want to be. They've highlighted even that they would be seeking partners or seeking third-party capital, as they put it, for their securitized products business, which has fewer links with the rest of the bank. So that business, I mean, certainly they will be looking at trying to move out of it in some way. Analysts say that really to get the full benefit, you have to really sell the entire division. But other businesses as well. I mean, look at leveraged finance and high yield bond issuance. Potentially also equities would be an area where they could be shrinking further, either because they want to reduce that capital intensity or also just to reduce the costs which these businesses are swallowing up. The investment bank has, in some businesses, delivered great performance in individual quarters, but if you look at the losses over the years, every couple of years they've had to take, it's a tough business to really argue to be in for the long term.
Well, in about a minute here, Nick, but just sort of overall, how has performance been for the businesses at Credit Suisse?
Equities trading and debt trading have had a tough time this year. I mean, I think it's also a question of just maybe some clients losing confidence in the bank. The advisory side had a great second quarter, so you can really, that's easy to argue for keeping it. But it's really a question of sort of winning back the trust of clients in trading. It has been a tougher job for them.
Okay, Nick, thank you very much. It's our European finance reporter, Nick Comfort, giving us the latest on Credit Suisse. Shares are actually higher this morning, a 4% drop yesterday, today, making up some of that lost ground, up 2%. Now, coming up, global food prices dropped for a fifth month in August. We're going to get into the drivers and the outlook next. This is Bloomberg.
What do you think of when you think of a battery?
For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Bearing the burden, inflation concerns, recession risks, and central bank policies push global bonds to the first bear market in a generation. It's U.S. Jobs Day. The hotly anticipated data has the potential to tip the scales towards a third jumbo-sized Fed hike this month. Crunch time, EU leaders warn Europe may not be able to avoid energy supply shortages this winter, even as flows look set to resume through the Nord Stream pipeline. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, global food prices, they fell for a fifth month in August. That's after demand for some products weakened and there was a seasonal uptick in supplies. Falling prices may offer some relief to consumers as they grapple with a deepening cost of living crisis. Let's bring in Alvin Tai from Bloomberg Intelligence on this. So, Alvin, are we at a point yet where we can decisively say that global food prices have peaked?
Hi, Danny. Yes, I believe so. If you look at the Bloomberg Agriculture Spot Index, it has given up about 100 points of the gains that it made in the last 2 years. I think there are actually more to be given up once the market is sure that the upcoming La Nina will not have any negative impact on prices. Bear in mind that prices are still relatively elevated compared to where they were pre-La Nina, so there are actually, more prices to be given up in the months ahead.
Right. Alvin, thank you for laying out the scene for us. Alvin Tyne there, Bloomberg Intelligence, our intelligence analyst there on agriculture. Now we're joined by Aaron Collier, economist in the Trade and Markets Division of the UN's Food and Agriculture Organization, which of course just put out this report this morning. So Aaron, our analyst Alvin there saying that he does believe that it looks like we've reached a peak in prices. So perhaps they've peaked, but I do wonder how much of a comfort will that be for nations still having to shell out for food that's more expensive than average?
Yeah, thanks so much. Right, as you mentioned, food prices reached a record level actually in March, which was a very concerning level for food prices in the world. They have been coming down in recent months. We saw them ease again in August, which is the good news. But the bad news, as you mentioned, is that food prices are still really, really high. They're still even marginally above previous records set before this year, which is in 2011. So seeing food prices still really high, and a point of concern is the fact that cereals, which have been a main driver of these price increases, remain very high. They actually decreased the least this month. And as you know, in cereals, wheat is a very important staple food for a lot of countries in the world. So right now with prices so high, especially with the US dollar so strong, that will make importing those supplies really expensive for a lot of countries.
Yeah, that's exactly where I wanted to go next, Aaron, in terms of dollar impact for these nations that are facing weaker currency. In terms of the geological divide, where does it seem in terms of who's facing the most pressure from that, the need to pay up more, again, because of the divergencies among global currencies?
Well, obviously, first and foremost, it's countries that rely on imports for their food needs. So, import-dependent countries, also low-income countries, especially those that are facing economic challenges in the wake of the pandemic. Also, concern has been on countries, especially in Middle East and Northern Africa, that are typically big importers of wheat, especially from Ukraine and Russia. So now that the supplies have been disrupted from that region, from the Black Sea region, for nearly 6 months now, that obviously, has created higher costs for those countries to import the wheat that they need.
Aaron, what will it take to see normalization? In other words, how far away are we from a level that's more comfortable?
Well, like I mentioned, prices are still above the 2011 record, so we still have a ways for prices to come down. And I think it's really important that the export flows out of Ukraine continue. We saw prices drop in response to the opening of ports in Ukraine pretty quickly in July. So that is it's very clear that that's having a big impact in helping to bring prices down by boosting supplies. So for that to continue, I think is a really essential part of that happening.
How worried are you? This is a narrative that picked up speed after Russia first invaded Ukraine. This idea that we would see more hoarding of commodities, of assets, be it agriculture, be it energy. Does that seem like a threat that could be lived out, or are we less concerned about that than perhaps we were at the beginning of the war?
Yeah, at the beginning of the war, there were certainly kind of a wave of a lot of policies being implemented to kind of protect domestic supplies, which, when you see that happening in major exporting countries, especially restricting exports, that will push up prices, that puts pressure on markets, which is something we want to try to avoid. So it does seem that has started to improve that situation. Again, like I said, even the fact that ports opened, Ukraine starting to see markets open a little bit more, and that's something that we need to see continue.
When it comes to the impact of droughts we've seen and extreme climate from, not just droughts, but floods in other regions as well, if this is the new normal, Aaron, what does it mean in preparing for the global food trade? What does it mean for global agriculture going forward? Are there structural changes that need to be made if this is the new reality of climate?
Yeah, this year we're forecasting to see a pretty big fall in maize production, for example, at the global level, which is making maize markets really tight. And that puts upward pressure on maize markets, which also in turn puts pressure on wheat markets, which is, as I mentioned, a very important food staple. So that fall in production really has a big impact. It's something that countries need to be very cognizant of. And, as weather patterns get more and more extreme, this year we've seen really hot and dry conditions in the European Union really cut into their maize production. We've seen hot conditions in India cutting into their wheat production, now flooding in Pakistan, maybe increasing the food demand that they have there. So, looking at production and putting in place support for producers to try to ward against these really extreme weather patterns, as they get worse and worse, is going to be really important. And again, mostly support to producers for them to be able to weather the costs of production that comes with. This year, we're already seeing record high, especially now with record high, energy prices and fertilizer prices being a very big concern, especially in the European Union for fertilizer production. As we see inputs become more expensive and farmers unable to purchase those inputs, that is going to be something that governments really need to help support the producers with.
Okay, Aaron, I'm afraid we're going to have to leave it there. Thanks so much for joining us, though. Aaron Collier there, economist in the Trade and Markets Division of the UN's Food and Agriculture Organization. Let's get to your Bloomberg Business Flash. With that is Leanne Gerrans. Good morning, Leanne.
Hi, Danny. The arrest of Glenpoint Capital co-founder Neil Phillips for alleged foreign exchange market manipulation is threatening to ripple across the hedge fund industry. Another firm has now suspended staff who previously worked with him. Phillips, who was associated with some of the biggest names in the hedge funds world, was arrested in Spain at the request of the United States. Now, Shell is reported to have shortlisted candidates to succeed Ben van Beurden, who is preparing to step down in 2023. According to Reuters, a number of internal picks are being considered. Van Beurden will leave after almost a decade as a CEO. Credit Suisse is reported to be weighing 4,000 job losses as it overhauls its business after a series of financial and reputational scandals. German newspaper Handelsblatt says the figure does not include cuts in investment banking. Executives are currently meeting in Singapore to discuss the company's strategy. And Lululemon shares have jumped in late U.S. trading after it raised its full-year outlook to more than $7.9 billion, beating analyst estimates. It is the latest sign that demand among high-income shoppers in the U.S. remains strong, even as inflation hurts purchasing power more widely. The company is aiming to double sales by 2026. That's by targeting men and opening more stores overseas. And that's your Bloomberg Business Flash. I know we like a bit of athletic leisure wear, Danny Berger.
Certainly cannot get away with wearing it during our job, but, you know, maybe on days off, Leanne.
Well, we're sitting on the sofa, Danny, yes.
Oh, I was going to say the gym, but hey, the sofa works too.
Big camp, yeah, we'll put it that way.
Leanne, thank you so much. Leanne Garens there. All right, coming up on the program, power problems. The EU sees its limits to its interventions in the European power markets. Well, that story for you next. This is Bloomberg.
A digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing? When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
But look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
Yes, it's about renewables.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. An emergency intervention in European power markets may lower prices, but it won't protect the region's economy from spillover effects of a historic energy crunch. A policy note seen by Bloomberg says that while the intervention tools can help mitigate the effect of the crisis, they will not bring energy prices back to pre-crisis levels or remove the significant effects of the crisis on the European economy as a whole. For more, let's bring in Anna Sheryayevskaya, our European natural gas reporter. So, Anna, of course, everyone is waiting for Nord Stream over the weekend. Of course, it indicates that a restart of flow from Saturday night will occur. Does this alleviate the worst case scenario, or are there still massive supply concerns left for winter?
Indeed, that helps alleviate concerns, especially as there have been risks that in the market that this pipeline would not restart as planned after 3-day maintenance. At the moment, we see the shipment orders indicate that the pipeline will restart, but the restart will be at the same limited 20% capacity, because only one turbine is operating out of 6 major turbines and 2 small. The others are out of service, and it's not clear when they will start. What's more, Gazprom has said that this sole operating turbine will have to be serviced again after every 1,000 hours. That's in 42 days. So potentially we're looking at another shutdown in the mid of October, when the heating demand starts increasing, and that could again raise questions of how long maintenance lasts, when Gazprom will restart, at what levels.
I mean, Anna, that just feels like continued opportunity for fears for volatility. If we have more of these potential, shutdowns of the pipeline coming, I mean, how much fear is there in that, or is there any comfort right now from the fact that they have, although it depressed volumes, the flow does continue to reopen after maintenance?
Yes, indeed, the prices have decreased today, so we're seeing this already factored in. But at the same, prices remain several times higher than normal levels for this time of year, and we're not even in the winter season yet. What's actually also helping get some relief to the market is that storage levels are sufficient. In the European Union is ahead of its target for storage refill by 2 months. So there is some comfort knowing that even if Russia stops gas, and we have sufficient stocks, we still have LNG coming to Europe. And of course, there should be demand reduction measures to guarantee that the winter supply will be unaffected.
Well, that being said, what are the steps that the European Commission is proposing to help alleviate some of the worst of this energy crisis?
Indeed, now attention is on the power market, what the EU wants to do to just rein in this unprecedented rally in the power market prices as well. And the short-term measures include reduction in power demand, including for market incentives, and price caps on non-gas power generation, such as nuclear, coal, and renewables, and limiting revenue for power generators, basically a windfall tax to ensure enough support and lowering bills. All these, as you mentioned earlier, as short-term measures, and the longer term, the European Commission is still debating on how to decouple gas prices. And yes, so at the moment, we are only talking about a short-term fix.
Can you walk us through what that long-term fix, that decoupling, would actually look like, how it would function, and the potential effectiveness of it?
Indeed, the details are still to be ironed out. We haven't heard much from the European Commission exactly how that will work. I think we'll have to wait till the meeting and the proposals of that measure. Indeed, power price, it's not all power generated from gas in Europe anymore. We have renewables, so I guess that calls to factor that in, and just to conduct a power market reform, and see how that materializes as we approach the meeting.
Okay, Anna, thank you very much for joining us, giving us the latest on the European energy crisis. That's Anna Sheryayevskaya, our European natural gas reporter. Coming up, U.S. chip stocks tumble after Washington imposes limits on exports to China. We'll have more of that and the market impact next. This is Bloomberg.
There's an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then betray you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Donald Trump and the MAGA Republicans represent an extremism that threatens the very foundations of our republic. MAGA Republicans have made their choice. They embrace anger. They thrive on chaos. They live not in the light of truth, but in the shadow of lies. More and more talk about violence as an acceptable political tool in this country. It's not. It can never be an acceptable tool. So I want to say this plain and simple. There is no place for political violence in America, period. While the threat to American democracy is real, I want to say as clearly as we can, we are not powerless in the face of these threats. We are not bystanders in this ongoing attack on democracy.
U.S. President Joe Biden there during a primetime address in Philly. Of course, important context, the U.S. heading into the midterm elections. Biden there clearly trying to stoke some concern, stoke some outrage, perhaps, as he hits the campaign trail for those running in the midterms. All right, now let's get to the Bloomberg First Word News. With that is Leanne Gerrans. Leanne.
Hi, Danny. Supermarket shelves were emptied and anxious motorists filled the roads trying to get home in the hours before Chengdu's 21 million residents were put into a strict lockdown. It's the fourth Chinese megacity to be locked down so far this year as Beijing pursues its COVID-0 policy. Local officials have given no information on when that lockdown will lift. Now, the company that runs the Zaporizhzhia nuclear power plant in Ukraine says a team of UN inspectors will remain there until Saturday. It's the first time that IAEA's 65-year history that monitors have crossed an active battle front in order to carry out an inspection.
I'm glad you pointed out that the inspectors are there. We're glad to see that. We hope that they're given unfettered access, and we look forward to their report about the safety and the operational efficiency of that nuclear power plant, because, again, the danger could be so much bigger, not just to the people of Ukraine, but even to the region.
Starbucks has named Reckitt Benckise's executive Laxman Narasimhan as its next CEO. He'll join the coffee giant at the start of next month, taking over fully next April. The consumer industry veteran is set to inherit issues including a growing union push and struggling sales over in China. Employees in the UK stepped up recruitment last week in preparation for a rush at Christmas. The Recruitment and Employment Confederation says 2.08 million million new jobs were advertised, the highest figure for 2022 and the second highest on record. The figures suggest labour shortages will continue to be a problem for business. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Danny.
Leanne, thank you so much. The latest U.S. effort to restrict chip exports to China from NVIDIA and AMD has sparked concerns that escalating government actions could cut off some of the semiconductor industry's biggest companies from the largest market for their products. Joining us now is Bloomberg's Charlotte Yang on this. So, Charlotte, we had this pretty ugly global sell-off yesterday when it came to the semiconductors. Walk us how we got here, how we got to this turning sentiment on them.
Yeah, so global investors have been on a selling spree of semiconductor shares since the report that U.S. is escalating efforts to curb some chip exports to China. And the sobering warning from NVIDIA that about $400 million could be hurt in sales, that's just this quarter alone, if it doesn't get permission from the U.S. government to export those chips into China. This is dragging market sentiment down a lot. And, considering that the Philadelphia Semiconductor Index has already down over 30% this year because the sector faces high inflation, excess inventory, as well as this waning demand from personal computers. This is a listing of an escalating technology boycott from U.S. on China. It's a listing that investors want to see.
So, we do have pre-market. Some of the U.S. chip makers are up slightly, but of course that could just be sort of a factor of the deep sell-off they saw yesterday. But one thing we did see, Charlotte, is in the Chinese session, some of those Chinese chip makers were able to surge, were able to defy the market gloom. Why is there such a different story there?
Yeah, so the Chinese semiconductor shares in today's trading are telling a very different story. We're actually seeing some of those shares throwing a rally party, even though it could be short-lived, as some of those speculative bets come from investors. So the main logic is because some investors see that as U.S. intensifies efforts to curb exports to China, then these homegrown producers will be able to get more market share, even though their technology at the moment is still behind. And we've seen this kind of trading strategy in the past as well. And the one notable example today is this AI chip maker, Chemicron, which surged as much as 20%, has already entered overbought territory.
Okay, Charlotte, thank you very much. That's Bloomberg's Charlotte Yang there. Some breaking lines now on Credit Suisse. They have been hit by some key resignations in their private bank, specifically in Hong Kong. Bloomberg has learned of 2 resignations, managing director on the China team who resigned this week and a team leader on the Hong Kong team. Now, Credit Suisse, when asked, said that they don't comment on these moves, but referred to a statement saying that in spite of all these rumors flying around that Credit Suisse is pulling back or pulling out of China, China is still a long-term play for us. Of course, this also comes in the context of a revamp from Credit Suisse as they face some of the outflows when it comes to the scandals that have triggered billions of dollars in losses. All right, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Kriti Gupta, and Tom McKenzie will take you through that. This is Bloomberg.
is the chance of humankind to really understand itself. How much of that is true? How confident? Did you actually overachieve? Did you, back then realize that we would be using AI in many different jobs? Was it slower or faster than you thought at the time?
I think if I had a 35 or 40-year prediction task, I would have been more or less on track as to where we are today. But I would have predicted steady linear increase over time. But instead, the field had very minimal improvements until the last 5 or 10 years. Then it really took off. I think we ended up in the right place, but I was very wrong about the trajectory. To this date, we still know very little about how the brain works, but these machines are getting ever more powerful. And I feel in some sense, we did end up learning what human intelligence is by learning what it is not. If we exclude all the things machines can do better than us as what makes us unique in our human intelligence, then now we can rule out many, many things, because AI or machine learning has become so good at so many things that what's left must be the key aspects of human intelligence.
The difference between political gossip and policy intelligence. Bloomberg Government provides our clients with expert reporting, analysis, and public affairs tools that give you the edge in reaching policymakers on the Hill. When you're in the business of influence in Washington, information and connections are the currencies on which you rely. For knowledge you can act upon, the difference is Bloomberg Government.
We have to be able to give our customers vehicles, that are their primary vehicles that are EVs, and to be able to do that, we need to have range and infrastructure, and we need to remove the pain points, and so that's what we're doing.
I'd be comfortable with some weakness in labor markets if we start to see some job losses. But to be honest, we're far from that today.
We're going into this with an incredibly strong job market. This is not like other situations we've had historically.
We won't be able to get the strong labor market conditions we had in the last expansion unless we get this inflation down.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It is 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Jobs day in the US. Today's numbers could determine whether the Fed decides to go for another jumbo-sized interest rate hike this month. President Biden banks on Democrats' outrage. He blasts Donald Trump and his supporters in a speech aimed at rallying voters ahead of November's congressional elections. And Europe's natural gas market gets some relief. Prices fall as Russia prepares to resume gas supplies through its key pipeline. Welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London with Matt Miller and Kriti Gupta in New York. Anna Edwards and Kaylee Lines are off today. Kriti, whether you're in London, in New York, it really is all about the jobs number today.
It is all about the jobs number, and I think it's a sentiment that was shared in the Asia overnight session as well, where you did start to see a little bit of a risk-off tone. The hangover there in that region, well, it really continues. The MSCI Asia Pacific Index down about 0.5%. Remember, that selling conviction that we've seen the previous days did not carry on last night, perhaps abating just a little bit. That wait and see, still in wait and see mode. How much of catch-up does it play come Monday's session? That being said, we are seeing a lot of pain when it comes to tech. The Hang Seng Index, for example, a lot of tech concentration in that Asian index specifically, that down about 0.7%, underperforming the broader market. But of course, part of that tech story, a huge part of that tech story, is the chip saga. The idea of how much kind of deglobalization is really playing out in the chip sector, whether it comes to United States regulation or simply a lack of production in the Asia Pacific region. And that is actively going to affect the Kospi index, the South Korean index, where of course we know Samsung is a major heavyweight, down about 0.3%. And true to form, I have to stick to the currency story. Dollar yen once again hitting some new weakness here. We are at a now 140 handle on that currency pair. Matt, it just gets worse and worse.
Yeah, absolutely, and it still remains interesting nonetheless. Take a look at what we're prepared for here in the U.S.
This is what happens when you have a big data print like a jobs number or a Fed decision. Equity traders sit on their hands. A lot of times they'll turn the algorithms off as well because they're worried that the machines won't be able to read the data as well as humans will. So far. Right now, so S&P futures unchanged. U.S. 10-year yield also very little change, but at a relatively high level. And it seems like the debate about the end of the bond bull market has come to a conclusion, especially since the global ag has now indeed fallen 20% from its peak at the end of last year. So right now we're looking at 325.56, and most strategists don't think we're ever going to go back to the lows that we saw, or not in the near future, during the pandemic. The Bloomberg Dollar Index hit an all-time intraday high yesterday. Remember I told you Valerie Titel, our London charts producer, pointed out it was 1304.55, I believe, July 14th, and yesterday we soared above that. Came back down a little, but we're still near there at 1302.59, and then Bitcoin also really not doing a heck of a lot. So there's so much going on, Tom, in markets, but risk assets really aren't moving that much as we wait for this jobs data to come out at 8:30 a.m. New York time.
There's a little bit more traction here in Europe. Part of that you would assume is a bit of catch-up in terms of the modest gains that we saw stateside yesterday. And of course, you've had, the context is 5 straight days of losses in Europe. Turning around that sentiment today, a big part of that will be what's happening in gas, and I'll break that down for you shortly. But broadly, you're seeing gains of about 0.8% here in the UK. The CAC current is up 0.7. Over in Germany, gains of more than 1.4%. And it's autos that is powering the gains over in Germany. Let's switch it over then and see how things are playing out across asset. I talked about the gas picture, so the news that that data around the pipeline suggests that flows will come back on Saturday, even as our team points out that they are expecting the Russians to have regular treks on the pipeline, which could lead to further volatility in gas prices. You have seen that drop almost 9% on Dutch gas today. That is supporting the euro, and it's also playing into what's happening across these equity markets. Gains then across the benchmark of 0.8%. Euro dollar still below parity, but upside of 0.3, and part of that will be gas. A number of FX strategists saying it's more about the energy picture than rates when it comes to the single currency and its direction going forward. Shell, this is one corporate story that I just want to pull out for you. Reuters reporting that the CEO, Ben Van Beurden, will be stepping down in 2023. Seems they've got some internal candidates being lined up. Gains of 1.7%. He's been in charge for about a decade, and it has been consequential in the transition for that company. Kriti.
Certainly something we are going to watch. Now let's take a look at what is ahead today. Tonight at 5 p.m. UK time, the UK Conservative leadership ballot closes. The new Prime Minister will be announced on Monday. And the European House Ambrosetti Forum kicks off in Cernobbio, Italy. Speakers include Commissioners Valdis Dombrovskis and Paolo Gentiloni. And then the main event at 8:30 a.m. New York time, we'll get the U.S. unemployment report, well, U.S. employment report, I should say, for the month of August. All that payrolls number, of course, in the spotlight all week long. Joining us now to look ahead to that very jobs report is Michael McKee, Bloomberg Chief Economics and Policy Correspondent. Okay, what's the number? Tell us.
You're not too far off in talking about unemployment. I'll explain. But the number you want to watch when we begin is the headline number for jobs created. The forecast is for 298,000, but remember it was 250,000 for last month, and we got 528,000. So if we do get a really strong number, then that does point the Fed in the direction of 75 basis points, more work to do. 3.5% unemployment, not expected to change, and we are expecting a slight decline in the month-over-month average for wages, but not for the headline year over year. So that leads us to this question. What is it in there besides the total number that will affect the Fed? And that's going to be wages. Are wages still rising as job numbers, as the job openings numbers rise and unemployment falls? Wages have been going up. They've flattened out a little bit. Do they go higher? That's an inflation problem, and the Fed has to act. Do they stay flat or start going down? Then maybe that cautions to 50 basis points.
Yeah, and I noticed the Bloomberg Whisper number. Yesterday it was 270. Today it's 287. So getting closer to the consensus, but still under. And I'm just wondering, is that wishful thinking? Because these are obviously market participants, and they would like to see maybe the job pain coming sooner so the Fed feels the pressure.
That may be the case, and there is an argument at the Fed that you want to do it sooner, get the rate up as high as you can or as high as you think you need to right away to get ahead of inflation. But there are others who say, well, we haven't seen the impact of all the Fed rate hikes so far, and maybe it's going to be really harsh, so we should do it more slowly.
Because monetary policy lags, right?
Works with a lag. So that may be one reason for them only going 50 if the data is ambiguous. But we have the CPI report on the 13th rather, and that's going to be the real defining number.
All right, very interesting stuff.
Bloomberg's Mike McKee previewing those job numbers for us, and of course we know that officials in Washington DC are going to be looking ahead to those numbers as well. President Joe Biden, meanwhile, has accused Donald Trump and so-called MAGA Republicans of assaulting the foundations of U.S. democracy. In a primetime TV address, Biden urged Americans to reject any candidate backed by his predecessor in the November midterms.
MAGA Republicans have made their choice. They embrace anger. They thrive on chaos. They live not in the light of truth, but in the shadow of lies. But together we can choose a different path. We can choose a better path.
Okay, Jack Fitzpatrick, Bloomberg government reporter, joins us now. Jack, what really kind of stood out to you then from this speech by Biden? He got pushback from Republicans, but it's something that the Democrats, at least many within the Democratic Congress, have been pushing for him to do, take a harder line on this issue.
Yeah, I mean, if anything stood out from this speech, I think there are two pretty obvious takeaways. One, he mentioned Donald Trump by name very early on. For a while, President Biden tried to avoid mentioning Trump specifically, kind of moving past it, which makes sense because Trump is not on the ballot himself. But clearly it's gotten to the point with the legal issues around Trump and just the centrality of Trump in Republican primaries in these midterms that the president felt the need to go directly at Donald Trump and mention him by name. And really, I think the other point of emphasis was, we've heard this message generally from President Biden before, but the decision to hold a primetime address with the symbolism of holding this at the place of the signing of the Constitution. It's clearly a major point of emphasis and a major, I guess, line of attack heading into the midterms. He's been on the defense talking about inflation, the possibility of a recession, trying to reframe the campaign narrative around democracy and good government and the issues that have popped up in Republican primaries with support for Trump being so central to them. That's something that President Biden wants to be a bigger focus in the midterms in the next couple of months.
In terms of, what's happening on the geopolitical stage, it does look like the policies of the West are pushing Iran closer to Russia and China. And now, obviously, that puts the possibility of a nuclear deal, which was already a very small possibility, really in question, doesn't it?
Well, yeah, the last news on this was bad news. The U.S. put out a statement from the State Department saying that the most recent response from Iran was not constructive. They haven't said specifically what the latest issue is and what their objection is, and the president was going to be briefed on this after coming back to Washington after that speech, but they said that the latest news is not good news. That's in the context, though, of people talking about a deal in the relatively near future. French President Emmanuel Macron said he was hoping for this to get wrapped up and have some sort of agreement in the next few days. And before this response by the U.S., they'd said that there had been some constructive dialogue. So I don't think it's been entirely bad news, but it's not something where they're quite at the finish line just yet.
Okay, Jack Fitzpatrick out of Washington, of Bloomberg government, of course, on the complexities around this Iran deal, at least the discussions on that deal. Now to the UK. Britain will have a new Prime Minister on Monday. Bookmakers and opinion polls point to a victory for Foreign Secretary Liz Truss, beating her rival, former Chancellor Rishi Sunak. Joining us now is Bloomberg's Lizzie Burden, on set, of course, here in London. Lizzie, give us a sense then of the economic challenges, and they are acute for the next PM.
They are. They're bigger than what Theresa May or David Cameron faced. You have to go all the way back to the early 1970s, to the oil shock and the miners' strike for a historical comparison to this. We've got double-digit inflation. It's only set to climb. The BOE sees 2 years of negative or zero growth. So what do we know about Trussonomics if she wins? Well, she says she prefers tax cuts to handouts, as she calls them, although she's rode back a bit on that more recently. She says tax cuts will help to stimulate economic growth. And to do that, she's probably going to need to do more borrowing, so she'll change the Treasury's fiscal rules, which is part of her taking on the blob, which is her word for the economic orthodoxy at the BOE and the Treasury. Of course, she blames the BOE for the inflation crisis. She wants to review their mandate. But all of this is worrying for markets. We had former Deputy BOE Governor Charlie Bean warning about a crisis in sterling and gilts. And if you look at the pound since Boris Johnson resigned, just for context, it's performed worse than 132 of 150 major currencies already.
And certainly on parity watch as well. We'll still go from the UK to continental Europe. Is 75 basis points from the ECB now a done deal?
Well, lots of economists have come and changed their call from 50 basis points to 75 basis points off the back of that new record Euro area CPI print, 9.1% in August, but also because of all the hawkish commentary out of the ECB and the Fed. Let's not forget Jackson Hole, Jay Powell's commentary makes the ECB look a little behind the curve, some on the Governing Council may be thinking. And so lots of economists have changed their call. Markets are fully pricing it in, but what economists say is it is not a done deal, because we had that statement from Philip Lane talking about the need for a more steady pace of hikes, and the worry is, what do higher borrowing costs do to a weaker economy like Italy?
Yeah, I think the Philip Lane, I guess dissent isn't probably the right way to call it, but advice was really interesting stuff. Lizzie, thanks so much for that. Lizzie Burden, Bloomberg's UK economics reporter. Now, Russia looks set to resume gas supplies through its key pipeline to Europe, a relief for markets for the short term, because fears persist, of course, about more halts this winter. Let's bring in Anna Sheriyevskaya right now, a European natural gas reporter. So, Anna, it looks like we've had a big drop in gas prices over the last week, I think 25, 30% at least. What are the remaining risks that are keeping the market on edge?
Obviously, the risks remain, and they're bound, even if Nord Stream restarts after 3-day maintenance and early Saturday. Still, only one turbine is operating on the pipeline out of 8. So that means that, and Gazprom said that that turbine will still have to be checked and maintained every 1,000 hours. That's 42 days. So potentially, if the other turbines are not put back in service before that, we're looking for another halt of pipeline in mid of October. That's when heating demand rises, and obviously implications would be much higher. And it just remains to be seen how long that shutdown would last, and if Gazprom could find some technical faults in the pipeline. So obviously that would keep us on edge for the entirety of the upcoming winter.
Bloomberg's Anna Sheriyevskaya, we thank you as always. Let's get a quick check on what's moving in the pre-market here stateside when it comes to those individual movers. I want to start with Moderna here. We know that boosters are now on the market. Omicron targeting boosters from, like you said, Moderna, Pfizer. Well, they're now ready for American use, and that is perhaps giving the shares a little bit of a boost here when it comes to Moderna, up about 0.2%. But once again, the entire market is rebounding just a little bit, not with a ton of conviction, but perhaps Moderna coming in on that trade. We should also take a look at some of the oil names. Exxon, for example, is back in the news. Shell and Exxon, I should add, selling their California oil venture to German asset manager IKAV. This is crucial when it comes to just kind of offloading some of their stakes. Shell, for example, getting $2 billion of cash out of the deal, and it's giving Exxon a little boost this morning as well, up 1.7%. Important to see that it's outperforming the pre-market action in futures. And Bed Bath & Beyond, our favorite retail stock that we like to look at, well, it's coming down once again, down about 2.5%. This is pretty normal as we start to see that build up in the meme stocks that's kind of having a little bit of a hangover now. A hangover, by the way, that has not really stopped as you start to really have a lot of questions about what this turnaround plan could actually yield, Tom.
Okay, this is our new favorite indicator, isn't it? Thank you very much, Kritty, on some of the corporates to watch. Coming up on the jobs numbers, Steve Blitz, T.S. Lombard, chief U.S. economist, will get his views on what it means as we look ahead to those wage prices and, of course, the overall number, the implications for the Fed. And Lindsay Vinjamuri from Chatham House, head of U.S. and the Americas program, get her analysis on that speech by Joe Biden and how it positions the Democrats ahead of those November midterms. Plus, we will get the Biden administration's take on the U.S. jobs report with Labour Secretary Marty Walsh. That is at 9:45 a.m. New York time. Stay with us. This is Bloomberg.
would shake, our love will remain. We will never, no, never. We will never, no.
Friday.
Why has Elon Musk said no to the car factory?
It's still in discussion. Let's see later the final result.
Do you think that by bringing people together, that is a way to solve conflict?
There must be communication, even if it doesn't necessarily resolve the problem. It is better to have dialogue than to have open conflict.
This is a conversation with President Jokowi of Indonesia.
Only on Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. We are simulcast on both radio and television. I'm Matt Miller here in New York. Kriti Gupta, Tom McKenzie with us out of London. Now, for now, at least, markets are still betting on a 75 basis point hike from the Fed in September. But of course, we get the all-important jobs number out at 8:30 a.m. New York time this morning. Noor Al-Ali joins us right now, Bloomberg Markets Live editor, to tell us if that makes any difference. Noor, is it going to change anything?
I think it'll absolutely make the difference and tip the odds further into the 75 basis point camp. I mean, I'm in the camp that supports higher rates for longer from the Fed. We've seen that kind of sentiment carry through from Jackson Hole. And if you look at indicators that the Fed look at, particularly their preferred inflation gauge, the core PCE, so those are the drivers of inflation, you'll see that it's quite elevated. So there's a lot of incentive for the Fed to raise rates higher for a lot longer.
No, what are the option markets telling us about volatility, expected volatility within equities?
Well, fantastic question. I wrote a post about this yesterday, and they are paying higher premiums for more volatility in U.S. stocks because that's basically seeking protections against that aggressive monetary policy. It's been a theme that we've seen so far this year where, you know, since COVID, they were protecting against the pandemic and those risks associated. But now increasingly we see, options premiums going higher back to those pandemic highs because, investors are anticipating a lot more volatility as we walk into that Fed tightening cycle.
Yeah, as you said within that post, which is worth checking out on the M Live, risk within risk. Thank you, Noor Al-Ali, great thing. Breaking down, of course, what's happening as we look ahead to that jobs number out of the US, what it means for the Fed, 75 basis points, and the options markets around volatility within equities. For more market analysis, do check out M Live Go on your terminal. Stay with us. This is Bloomberg.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers. infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Now, keeping you up to date with news from around the world, here's the first word. NASA will try again Saturday to launch its Artemis 1 moon rocket. The space agency tried earlier this week, but the launch was scrubbed because of a problem with one of the rocket's engines and other technical issues. It's the first major flight in NASA's ambitious plan to return to the moon, to return astronauts' boots on the moon. This mission is carrying test dummies, though, instead of real people. COVID booster shots that target the most common new variants should become available in the U.S. within days. That's after the CDC signed off on the rollout of the updated vaccines. Moderna makes one of the shots, and the other one comes from Pfizer and BioNTech. Laxman Narasimhan, Starbucks has named Reckitt Benckiser's chief executive, Narasimhan, to be its next CEO. He is a veteran of the consumer industry. He'll join Starbucks next month, while longtime leader Howard Schultz stays in charge. Narasimhan fully takes over next April, but Schultz is still going to stay on the board. Among Starbucks issues, struggling sales in China and a push to unionize workers. And Tom, I just was thinking it will be difficult for him with, the boss around all the time. I wonder if Schultz at some point steps back.
Yeah, I think that personal dynamic is going to be really fascinating to watch, isn't it? Schultz took over again in April. He's pushed through a lot of big changes, so we'll see how that dynamic plays out. Coming up on the numbers, of course, Steve Blitz, TS Lombard chief U.S. economist. This is Bloomberg.
Apple has identified its next big business, bringing advertisements to more parts of your iPhone. Today, Apple pushes ads in 3 places: the App Store, Apple News, and the Stocks app. In the News and Stocks apps, Apple shows display advertisements. That means that third-party companies like car dealerships or mortgage lenders can showcase their advertisements just like they can on a website. On the App Store, the situation is different. There, Apple has search ads. This allows developers to buy their way into showing up higher on search results. For instance, an App Store developer can bid for the term car racing or basketball, so their apps would surface above competing apps in the list of results. Apple's push into ads is a little ironic, given that its ATT, or App Tracking Transparency Privacy feature, limits the ability for Meta, Snap, and even smaller developers to generate as much revenue as possible from advertising. That's because the feature allows users to choose if they want their data collected and tracked across third-party apps and websites. Still, Apple's hoping to expand its own ads business and is planning to add search ads to its Maps app. Other areas where ads could eventually appear are on Apple Books and Apple Podcasts, along, maybe one day, with an ad-supported tier of Apple TV Plus to compete with new offerings from Netflix and other streaming video providers. I'm Mark Gurman. This is Power On.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Jobs Day in the US. Today's numbers could determine whether the Fed decides to go for another jumbo-sized interest rate hike this month. President Biden banks on Democrats' outrage. He blasts Donald Trump and his supporters in a speech aimed at rallying voters ahead of November's congressional elections. And Europe's natural gas market gets some relief. Prices fall as Russia prepares to resume gas supplies through its key pipeline. Welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London with Matt Miller and Kriti Gupta in New York. Anna Edwards and Kelly Lyons are off today. Matt, the US job numbers, 298,000. That is the estimate.
That's the estimate, and we're waiting for that number to come out before we do anything. I mean, it looks like there's a whole lot of nothing going on in markets, but don't turn off the TV because the levels are very interesting, and these markets could move bigly after that job number comes out, right? The S&P futures are doing nothing, but Savita Subramanian came out and reiterated her target of 3,600 to the downside. Meanwhile, you've got a lot of the other big name strategists like Binky Chadha and Tom Lee and Klonovich all saying, 4,600 or 4,500. So there's a real divergence in opinion. And it all hinges on the Fed, which is watching this number very closely. We have the 10-year yield right now also not doing much, but at 325. And now we've seen the global ag, this big index of government and corporate debt, falling 20% into a real bear market from the highs at the end of 2021. So that's a really big story as well on the bond side. The dollar index, right now the Bloomberg dollar index, which I think is a much better index than the DXY, that's the old school Wall Street. This is the new way of looking at the dollar. It's at an all-time high, hovering right around there, over 1,300. And that makes a huge difference to the Fed. It makes a huge difference to the economy, and it makes a huge difference, especially to countries outside of the U.S. Bitcoin, okay, we still leave it up there because crypto is still kind of a hot fad, but it's at 20,000, and it's going to track other assets as it does. But I just think, Tom, it's so fascinating to see all these levels, and if the job number misses, maybe that pushes the Fed to reconsider how hardcore its stance is. If it beats, maybe we get a 75 basis point hike in September. Kriti?
Yeah, Matt, I am looking at some of the pre-market movers this morning. You are starting to see some movement in some really an old story here. COVID coming back to the forefront. Omicron targeting boosters from Moderna and Pfizer are, well, they're now ready for the U.S. use. So you can actually go to your pharmacy. You can actually go grab them. And that is perhaps giving a little bit of a lift to shares of Moderna, up about 0.2%. We'll talk about Shell as well. They're both selling their California oil venture, their stakes in it, to German asset manager IKAV. Shell specifically about to make $2 billion in cash off of that transaction. For Exxon, it means a lift in their shares up about 1.5%. And of course, a retail favorite, the one spot where you don't see green on the screen, Bed Bath & Beyond shares down just shy of 4%, Tom.
Okay, gritty across European equities. You're seeing gains of 0.6%, a little bit of catch-up given the gains that we saw, the closing out in the green of Wall Street, but also the gas factor. And you have seen now Russian gas data suggesting around the pipeline that those gas flows are going to come back on Saturday. And you've seen as a result of that pressure on prices down around 13%. The context is across this week, you've seen a drop of about 30% in terms of gas prices. Still very, very high levels historically, but a little bit of temporary relief, at least at the margins, when it comes to the energy story here in Europe. And that has given a bit of a boost to the equities market. Autos gaining, particularly on the back of that, given the industry in Germany and the reliance on gas. Euro dollar is also part of the mix there when it comes to that gas story. Gaining 0.4%. Part of that, of course, softer dollar, but also playing into that is what's happening around the gas price. And Shell, this is one corporate story we just want to pull out for you. Reuters reporting that the CEO, Ben van Beurden, will be stepping down in 2023. He actually cut dividends for the first time last year, for the first time since World War II. And he's also been pretty consequential in reworking that business as they move more towards renewables. Gains of 1.5%. They have two candidates internal candidates within the business. It seems like, to take over from Ben van Beurden. Matt.
All right. We have with us right now one of the economists from whom I've learned the most at my career throughout Bloomberg. Steve Blitz is here. He is the chief U.S. economist at TS Lombard. We've been talking for a couple of decades now, Steve, so I'm really excited to have you in the studio. I want to ask about, I think, one of the most interesting dynamics that we're looking at today, and that is the non-accelerating inflation rate of unemployment, NAIRU, which we haven't really talked about that much since the great financial crisis. But now it looks like we way undershot that, and the Fed wants to squeeze unemployment a little bit higher. How do you think that dynamic is going to play out?
Politically or economically?
Well, that's exactly my question, right? Because if they start putting Americans out of work on purpose, Elizabeth Warren's already questioning it, and more people are going to be angry about it.
Yeah, exactly. And as much as people don't like paying high gasoline prices, I mean, this is more politics than it is economics. If you go back to when Reagan got elected, there was a clear vote in the United States to end inflation. So it wasn't questionable. And so people were, at least politically, they weren't happy about 10% unemployment, but there was a political will in that direction and to do the things that were necessary in order to accomplish that. I'm not so sure that you have that same will today. And I think what is more likely ends up is that the Fed's going to look at this 2% target and say, what was so special about 2% anyway? That maybe 3% is the right number. So along the way towards a higher unemployment rate, and we're going to get a higher unemployment rate, and the Fed is going to create a recession.
But at what point does the unemployment rate start to really freak people out, make people angry, put pressure on Jay Powell?
My guess, it's a pure guess. My guess is around 4.5%. Once that, we're like a big, just like here, you're big-handled people, right?
Yep.
It's like when the equity market goes from a 4 to a 3, all of a sudden, or in the other direction, it's a lot of news. So I think once you get over 4%, right, because you're at 3.5 now, people are really going to start to take notice.
So the issue at the heart of the labor market is that it's disjointed, right? You have these massive job openings and you have a very tight labor market. What is the time frame to put things back into the normal? What kind of time frame are we looking at?
You're never going back to normal, okay? I mean, that's the truth. And look, I said this 2 years ago. Whenever you have a recession, the ensuing expansion is always different than the other one. Right? I go look at the 60s, 70s, pick your decade. They're all different. And the mistake everyone makes is to assume that the prior expansion, or what it looked like, reasserts itself. So think about it. Because of COVID, you've got a lot of people over 65, over 60 who've left the workforce, right? They're not coming back, right? I don't think that Bloomberg is having a job fair hiring 70-year-olds, right? So they're not coming back into the workforce. The Gen Z generation, which is just now at the front edge of coming into the workforce, is smaller than millennials. And then you have all the H-1B visa things and stuff like that. Again, you can talk to Bloomberg HR department about getting people from overseas into the U.S. And under Trump, that got broken or changed or disjointed or whatever adjective, but it's different, right? And so you have a permanent shift in the supply of labor, right? And at the same time, with reshoring, you have an increase in the demand for more skills because that's where the job growth is going to, as opposed to leisure and hospitality.
Steve, there was a really interesting comment, I thought, from Mike Wilson of Morgan Stanley yesterday, saying that he's concerned that maybe you get corporates hoarding labor, given the challenges they face post-pandemic to get workers back in to offices and factories, and that could pressure margins at the corporate level. Are you seeing any evidence of that?
Not yet, and I know that's a really strong narrative that in this recession, and that you're not going to get the same level of increase of unemployment that you have in prior ones because of this hoarding aspect. When firms have a hard time and earnings are poor, they're going to dump people. That's just what they do.
Well, and we're already seeing that, right?
Yes.
Like, for example, Snap apparently boosted its headcount by 50% last year. Well, no wonder they're cutting 20% of their jobs now, right?
Exactly.
And it's not just tech. We're seeing yesterday we had 3M, you know, one of the oldest industrials in the Dow, cutting jobs.
Right, and so firms will absolutely lay people off again. Now, because you don't have the same level of misallocations and problems that you have in coming into normal recessions, I don't expect 8–10% unemployment, right? I'm thinking more like 5.5–6%. If you want to say whether that's that's an okay increase or not, that all depends whether or not you've kept your job or lost your job.
Well, if 4
right?
wasn't full employment to Jay Powell, then 5 or 6% is terrifying, right?
Right, exactly. And so I think that you do get to 5.5–6%. My own work showed me that 5.5% is probably the quote unquote NAIRU, but NAIRU can change too. I mean, it's one of those numbers you really only truly know in retrospect, but I think 5.5–6% is probably where you end up going, and it's going to be disruptive. Look, it has been since the 70s, really, that you had a period where the inflation rate was so high above the unemployment rate, right? Not normally, but since Volcker, it's been the other way around. Right. The unemployment rate has tended to be higher than inflation, and you're not going to get that correction in some sort of fairy tale way. Well, the rest of the world is slowing. The point is that over the last 3 months, on an annualized rate, according to the Atlanta Fed, nominal wage growth is 7%, 8.5% for job switchers, right? And now you have full employment, and now gasoline prices are coming down, so it's no surprise that consumer sentiment is going up. So now you're getting into a point where you're going to ratchet up growth in going forward here. And I think the Fed understands that, which is why I think just as they look through the CPI number that we got in July, they're going to look through this August employment number. They're going to understand it's a little bit lagging. And also the general rule of thumb, you go back pre-COVID, was that 125,000 job gains per month was neutral in the sense that, the flows coming in and out that kept the unemployment rate where it is. So 175, 150, 200, just keying off of the ADP numbers, which who knows if they're right. We'll find that out in a few hours. But that's that's still a high number.
Solid.
Yeah.
Yeah, Steve, fascinating as well to read the Bloomberg economics analysis and their call that they've broken down the numbers. 100,000 is all you need on average over the next few months to keep that unemployment level at around 3.5%. So there's a long way to go, as you say. Steve Blitz there, fantastic insights, thank you, of TS Lombard. Coming up, Leslie Vinjamuri, Chatham House, head of US and the Americas program, get her views on that speech by Joe Biden, the threats to US democracy and where it leaves the Democrats and the Republicans leading up to November. Stay with us, this is Bloomberg.
very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
Yes, it's about renewables.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
While the threat to American democracy is real, I want to say as clearly as we can, we are not powerless in the face of these threats. We are not bystanders in this ongoing attack on democracy.
That was President Joe Biden in his primetime TV address. Leslie Vinjamuri, Chatham House head of U.S. and the Americas program, joins us now to talk about this. I don't know if about face is the right word, but it really is a change, Leslie. As the president came into office, he completely avoided using Trump's name even, and the progressive wing of the party was pushing for him to be more aggressive, but he wanted to be the president for everyone. I think he said that very recently. Now he's made it clear that is no longer the case.
That's exactly right. We saw in that speech a president driven to send a very clear message to Americans about the challenge to democracy, and that's backed up by the polling. We've seen recent polling suggesting that a strong majority of Americans see the threat to democracy as their number one concern. He's building on that momentum. He's also clearly trying to peel off mainstream, as he calls them, mainstream Republicans, as also being very committed to securing and preserving and rescuing America's democracy. But he really calls out Donald Trump by name, as you said, a real shift for this president, and the MAGA Republicans. He says this again and again, and that was a very powerful message. It's a big bet. This is a president who is more popular now than he was in July, who has had some recent successes. Polls, the Wall Street Journal polls have demonstrated that the Democrats are doing significantly better. If you ask people how they feel about Republicans and Democrats in their local constituents, it used to be that they felt better about Republicans several months ago. Now Democrats have a slight lead. You know, polling is always something that we have to take with some skepticism, but there's a bit of a bump for the Democrats. And I think most significantly, Donald Trump is back. He will be in Pennsylvania. It's very clear that that message will be loud. It will get a lot of attention. And the president, the White House, his team have decided to be very front-footed as we lead up to these midterm elections. The other thing to note, the White House Twitter account retweeted a New York Times article naming the 147 congressional Republicans that voted to challenge the result of the 2020 election. I mean, this is quite a concerted effort, and it's very front-footed.
Is that a strategy that's going to work, though, Leslie? Are we going to see some backlash from the GOP?
This is the big question. You know, it's not possible to know because there are multiple factors here, right? There are, you know, I would say three. One is that voter turnout, we think, will be driven by the reversal of Roe versus Wade, abortion rights, on the Democrat, but also on a number of moderate Republicans, women in particular. Voter turnout on the Republican side might well be driven by the feeling that the FBI investigations of Mar-a-Lago were politicized, not appropriate or fair. And then there's this speech and this concerted effort that we're going to see, which I think is exactly right. The threat to America is clear. The threat to democracy in America is very clear. There are concrete things to point to. But there will be not only many MAGA Republicans, many of whom won't be prone to violence, who will see themselves as patriots, as Americans, as will be pushed, I think, further away by the speech. But the real question is what happens to those mainstream Republicans, the same Republicans that I think Liz Cheney is hoping to court with the January 6 investigations. Will they be persuaded, if not only in the midterms, but which is, the immediate question, but going forward to peel off some of their support for the Trump wing of that party? It's a very tough call. It's a very big bet, but there's a lot of momentum and there's a huge amount at stake.
Leslie, you mentioned the FBI investigation and the raid of Mar-a-Lago. Which side benefits most from that?
Well, we have to hope that, America benefits most because, remember, national security, we don't know exactly what's in those documents. We're going to continue to learn more. We don't know where they went. We know very little, actually, still. But in terms of, the politics of it, it threatens to divide. And a lot, this is a dynamic moving factor. How it's covered, what facts turn up, how widely they're shared. Will absolutely shape how people feel about that investigation. Right now, I think it's quite divided. If we believe the polling, Republicans see it as political, as not just, not legitimate, not legally justified. Majority, according to some polls.
By the way, Leslie, everything is divided like that, right? I mean, I don't know why we keep citing approval ratings for presidents, because you can only do as well as 50%.
Sure. The country is polarized, the country is divided, but there are multiple things going on. And, again, the one thing that we've seen is that just shy of 70% of Americans think that their number one concern is the threat to democracy in America. Democracy is not inherently a divisive factor when what people think is fair, whether they think specific elections were conducted fairly. There's a lot of division along those lines. And America, as we know, is not only divided and polarized and facing a very sharp, very radicalized segment of a Republican Party that has a lot of influence right now. But that division grew dramatically in the 4 years that Donald Trump was president. The question is, what happens when we get to these midterm elections? And for a President Biden, who has had some recent success, it's been a very tough presidency. If those midterm elections don't go the way that he wants them to, and usually they don't for a sitting president, then the next 2 years are going to be extremely difficult. But this is difficult in a context which is not normal. And I think this is something that the president tried to say again and again and again. This is not normal politics.
Yeah.
There's something very significant at stake here.
Hard to argue it's not normal when the former president continues the lie that the election was stolen, and many of his acolytes, of course, as well. Leslie Vinjamuri, thank you, of Chatham House, on this risky strategy by the current President Joe Biden to take aim at Trump and the MAGA Republicans, as he calls them. Thank you. Coming up on Balance of Power, we will speak with Governor Glenn Youngkin, Republican from Virginia. We'll get his thoughts. Stats at 12 p.m. in New York, 5 p.m. in London. This is Bloomberg.
climate bill passes through Congress. The expansion of nuclear energy and more investment for companies at the forefront of the fight against climate change. In this episode of Bloomberg Green, we'll explore President Biden's climate bill.
I almost think there's no superlatives that capture the breadth and scope and scale of this law.
Find out what's actually in it and where it doesn't go far enough.
The thing that's not included here is a specific hard cap on CO2 emissions or a specific legislated goal.
And look at what more needs to be done to invest in modernizing and greening U.S. infrastructure.
What we haven't had is a plan that's realistic, time-bound, pragmatic.
I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing this weekend on Bloomberg TV, Quick Take, and online.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our targets.
Spare capacity is becoming scarce. We are running on thin ice.
No one deliberately wants to go into battle, but we sleepwalk into conflict.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Welcome back. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London, Matt Miller and Kriti Gupta in New York.
Tom Keene, co-anchor of Bloomberg Surveillance, joins us now. Tom, walk us through your single best chart.
What we've got today, Kriti, is a Labor Day Jobs Day chart. This is a chart from years ago. This made a huge splash pushing 20 years ago when I first put it together. It's not original to me. But as the manufacturing spirit of America is compared to total population, this is hugely political chart with Pearl Harbor over on the left side, the booming World War II manufacturing economy, and then the slow rollover and the stunning log descent that we saw in the last 20 years out to what I'm going to call the Obama leveling out, the pandemic, and we've sort of kind of like made it back. But it does show on this Labor Day weekend the decline of manufacturing in America. We can argue all day about the politics of it.
Well, what's interesting, Tom, I was on the elliptical yesterday at the gym watching you and John Farrow break down the Minnesota Mining and Manufacturing Company release. So we've seen job cuts out of, Snap and Coinbase, but now it's hitting real companies.
Yeah, this is a really good point, Matt. We'll talk to Randy Krosner about this, former governor of the Federal Reserve System. But, Matt, you're dead on about this is transferring from what some would say is zombie companies over to the real American economy. We'll do that on this Jobs Day. Michael Purvis scheduled.
Never nervous.
Tom Keene, thank you. That is it for Early Edition. Markets here in Europe up 0.5%, range bound with your US futures. This is Bloomberg.
We anticipate that you will have regulations clarifying what the SEC is going to do on cryptocurrencies and related kinds of things in the near future.
It's pretty clear that many of these tokens may be securities. What we've asked the trading platforms, the lending platforms, the other various venues to come in, to work with us, to get registered under the securities laws, because if a platform has 50 or some of them 500 tokens on their platform, probabilities are they're not all non-securities.
Now, there's another issue that has arisen, which is called gamification, which is to say people are making a game out of trying to buy stocks. Are you worried about this phenomenon?
We live in the 2020s in a new digital age where applications on our phones can use massive amount of data and then predict our behavior. What do we do when the digital algorithms are maximizing for the company's revenues rather than our returns? And so we're trying to think that through. It's not just gamification, it's a little bit more than that. It's whether there's a conflict between the app and our investment returns.
what happens politically and then what the economic fallout is.
What we're seeing right now is severe dislocations in the labor market, right? We're seeing supply and demand imbalances.
Equities generally are reflecting a path of policy tightening.
Certainly the Fed could use any help from any front it can get at this point.
The Fed ultimately, through its action, at a minimum, is going to cause a mild recession.
This is going to be a challenging back-to-school season. It could be a challenging Christmas season.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Do you remember a week ago today, Tom?
Exactly. Well said, John.
No, thank you. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Tom Keene, I'm Jonathan Farrow, together with Anna Edwards. Bramo back after the long weekend. Equities unchanged on the session. TK, we are down on the week. And every day since Chairman Powell spoke last Friday, yields inching higher at the front end.
This will be a different jobs day. We will cover the American labor economy, the report of mystery. We'll have to see what it's like after last time's festivities. But John, these markets say it can't be a normal jobs day. Yen, where it is, Philippine peso, truly record weakness.
Well, Tom, last month there was nothing normal about it. 528. Today the estimate 298. A week full of better than expected data. ISM manufacturing better than expected, claims lower than expected, consumer confidence firmer than expected. Tom, that's been the theme of the week. And you know you hate this and I hate it too, but good news has been bad news.
Oh, you're going to start right in on that.
Just going straight there.
John, Jim Glassman was maybe the best interview I've had with him yesterday for 35 years.
What did he say, Tom?
The giant of J.P. Morgan Chase. He was heated that the Gloom crew has it wrong. Heated.
Anna, does the Gloom crew get a bit of fuel for their debate a little bit later?
Yeah, well, let's see if good news, well, if there is good news, does it turn out to be bad, as we've seen recently, John? Yeah, the Gloom crew dominates. I mean, all the conversations we have with those in equities, certainly, I mean, it's difficult to find those who are positive. Every now and again we find one, but they're scarce.
We've established that good news is bad news. Is bad news good news? Anna, do we know?
No, I read yesterday from one of our guests that bad news is definitely still bad news. So basically everything's bad.
TK,
Sorry,
I can't
that's
keep
not a Friday message.
Tom, you're up to speed on this, and this is the problem. Bloomberg News wrote a great story about this yesterday. If I could guarantee you the number today at 8:30 Eastern, if I could tell you it right now, would you know how to trade it a minute afterwards, Tom? Would you know how to trade it?
No, you wouldn't, and there's been some real losses taken here. Let's remember that. There are some winners obviously out there. Steve Whiting's going to join us in a moment. John, what do we have to fall back on? The data screen that Tom Secunda and Mike Bloomberg invented. And I'm sorry, I got a 352 year. I got a yen at a one unimaginable 40. This tells me right now is a unique jobs.
And I've got another bank, Tom, looking for a 75 basis point hike from the ECB next week. Citi in the mix, and maybe another 75 basis point hike in the meeting after that?
Let's do this right now.
Sure.
You know, we got time's precious here, but I'm sorry. Ambrose Evans Pritchard lays out the John Farrow Watch Italy scenario today in the Telegraph. This has national consequences for them to go 75 beeps.
The spread of Italy over Germany right now, Tom, 236. So Badra Japa, I'll catch up with her later from SocGen. She says that spread, Tom, could blow out to 300 basis points.
I mean, it's so unimaginable. You'd actually think Americans would buy AC Milan. I mean, it's unbelievable.
Well, they're doing it, Tom. Yankees taking a little stake in that. Do you want to talk about that later?
We'll talk about that later. We got too much to do right now.
It's Payrolls Friday, Tom. I can tell you're excited. Futures up 0.1% on the S&P. Good morning to you. On the Nasdaq 100, we are dead flat. It's just the churn, the quiet, the peace and quiet, the snooze. Before the big one at 8:30, then 8:31, it's Operation Get to the Beach for the long weekend stateside. Do you know how this works? 325.95 on a US 10-year. Tom talked about a 2-year breaching 350, just south of that level right now. Euro dollar basically unchanged at parity, but looking for a move of a stronger euro through much of this week, Tom. Will we get it today? We're breaking out by about 0.6% right now, unchanged on much of the week so far. Let's get to Steve Whiting, Chief Investment Strategist and Chief Economist at Citi Global Wealth Management. He joins us now. Steve, I'm going to go to the question that we've debated all week, and forgive me for coming there first. We understand that good news is apparently bad news. If we got a bad print today, what would it mean for this market?
Well, bad print today, I think it would be very difficult to think that it would do anything other than delay the approach of the Fed, might buy us a little bit of time. Time is what we've needed, and its time is not what they're giving us. So in other words, this period where we're still seeing rising employment and we're seeing falling inflation rates now, this is a little bit of a period where we can have some hope of growing through this shock. But I doubt that a single month of data, I mean, consider what we're looking at in the month of August. It's mostly seasonal adjustment. It's a period, again, of weakness in the summer months. That's very, very seasonal, large swings. We to use all of this seasonal adjustment to show us a number, and we're supposed to figure out economic policy for the country on that.
Steve Whiting, you look at a basic textbook like Dornbush Fisher Stars, which is the one I was weaned on. The great Rudy Dornbush was Stan Fisher. And you're the only economist I know that read chapter 19, which is linking the financial markets back to the economic babble. What do you say about corporate margins, given the stew, as Lisa would say, the toxic brew that we're in right now? Do we have a gloom about corporate margins?
I think we do. This has been a strong period. 2022 will be another year of record high corporate profits. And everyone says, well, I haven't seen the weakness yet. Well, not yet is not relevant. It really is, what will we do next year? And that's the trouble here. Again, if you have a roaring hot labor market, if you have all of this strength contribute to a higher top, you're going to have a bigger problem next year. Now, again, I don't think we have had any kind of economic boom, like if you look back, for example, the mid-2000s in housing or the late 1990s in technology, these types of booms that were very, very difficult. We had a very long way to drop. I don't think we have that in the American economy, but we're still looking for a 10% drop in corporate profits next year.
A 10% drop. Where's that put SPX? I mean, you're linking both markets here. It's a fair question to you, given all that you do for Citigroup. What's your Standard & Poor's target?
So look, I think we're not going to make a lot of progress in broad averages. And we've not argued that, okay, well, it's really, that June low, we've got to go back and drop that a little bit more. That's not really what we're thinking about here. But we think it's been premature to discount a new economic recovery cycle when we haven't even seen the drop yet. Again, we're not expecting it to be some severe systemic collapse in the economy. This is an overheating. It's being driven by the Federal Reserve. We're seeing housing and autos, for example, very traditional parts of the economy weaken, and not from very high levels. We're not even satisfying demand for housing and autos right now in the United States. But both supply and demand are likely to drop some. I think we'll have a recovery in 2024, but it's just too early to say, well, this is the time where, the bear market is over, 2 down quarters for GDP growth. Let's go back to the races.
So, Steve, you're talking about a 10% drop in earnings next year. What does that do to dividends? I know that you think that's an important story to keep watching. I'm thinking because of the drop in earnings, but also perhaps in some sectors, political pressure if wages are not keeping up with inflation.
Well, depending on the conditions, we're going to see some sectors that will halt dividends. You will see, again, a slowing growth rate. But for most of the companies that actually pay a dividend, again, there's going to be a pretty good choice there to make. We, again, are very focused at Citi Global Wealth on firms that have the most consistent track record of raising dividends. Dividend aristocrats have done so for 25 years in the U.S. market, and that's through 3 economic cycles. The healthcare sector, our biggest single industry overweighted pharma, has grown dividends through every recession. 6% growth rate, not wonderful, but 3% yield, 6% growth rate. That is a very dependable source of return at a time when the economy is facing this headwind.
Steve, just finally, what would you need to see that would make you bullish again? What could develop? Because a lot of people are just writing off September already. What would you need to see?
Well, look, falling inflation and some recognition from the Fed that what the world doesn't need now is higher unemployment, right? We're not going to set this into a downturn that becomes self-reinforcing in the labor markets. Once we start seeing employment decline, it'll keep declining for most of the year. It's possible still to avoid that. It does look like, again, the Federal Reserve is on its way, though. Again, to setting us into one of those cycles, in which case they will ease again when employment is falling. And they may say, no, we're not going to do that right now. But when actual employment is falling again, not rising 300,000 per month, not rising at a slower pace, that's probably next year. It's not this year.
It's going to be a major test for this central bank, for this country, that's for sure. Steve, awesome to catch up. Steve Whiting there of Citi Global Wealth Management, going into payrolls a little bit later this morning, 8:30 Eastern time. So in about 2 hours and 20 minutes, we're looking for a number close to 300K, Tom, after a blowout jobs report.
Yeah.
Just a month ago.
Well, it's going to be interesting to see that number, and I'm going to be looking at wages, particularly off the new ADP, which I don't want to link to it, but I think the wage dynamics there, some of the little tea leaves, John, are interesting. Antoinette Antonio up at WCVB in Boston tweets out, under $4 a gallon gas in Massachusetts, $3.97. It gets my
About
attention.
where the average is, Tom. We've broken down.
There
was a fear we'd break through 6 at some point this summer.
Yeah.
Hasn't happened.
Hasn't happened, and I think you're going to see some people, I think Mike McKee was talking up used cars as well as being an interesting metric here.
The labour market data so far so good, Tom. Yeah. And I mentioned that the data this week so far so good. Steve Whiting said that to expect the breakdown of the labour market, Tom, a story for 2023. Yeah. That's going to keep this Fed busy into year end.
Our whole team's on vacation. We had security guys out at the front door booking the show. We got a great set of guests coming up.
Bramo took the long weekend, didn't she, Tom?
Did you notice that?
I did notice that. She's going to be back
I think
with us on Tuesday,
the last time I had a day off, I think was...
that feels like he's had a choice, Tom.
I think the Red Sox were hopeful.
Why is that? Why have you been so reluctant to take a bit of time off
I've done
this
There's been a lot of years I've done this. I just like the autumnal mist. I like to, take the day off.
You'll be waiting for the leaves to start to fall, and then you're going to take some time off.
The leaves get brown, as you say. And
old school.
I quote Robert Frost, and,
Very old school. I tweeted out a picture of your shoes a little bit earlier, Tom. Some confusion as to whose shoes they might be. Now everyone knows. And if you want to check them out, go on Twitter and have a little look. It's pretty obvious which shoes are mine.
They made a splash in Ibiza.
Which shoes are Tom's. They're going to stop traffic later, Tom. Coming up, 7 a.m. Eastern time, Priya Misra of TD. TK, what a call from Priya earlier this year.
Call of the summer, seriously.
Just awesome.
Call of the summer, no end for buts.
On the yield curve, looking forward to catching up with her. And Carl Riccadonna making a comeback over at BNP Paribas.
Is he new?
He is new.
Okay.
A new seat for him. Looking forward to that. Catch up with Randy Krosner. Tom mentioned him a little bit earlier this morning. And Jeff Rosenberg of BlackRock after the payrolls print later on. From New York City, good morning to you all. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden has given a preview of what his campaign message will be in the run-up to November's congressional elections. Last night, he accused Donald Trump and Republicans who back him of endangering democracy.
Donald Trump and the MAGA Republicans represent an extremism that threatens the very foundations of our republic.
House Republican leader Kevin McCarthy accused the president of slandering all Republican voters. Today's U.S. jobs report could tip the scales towards a third straight jumbo-sized interest rate hike. According to a Bloomberg survey, employers added 298,000 jobs in August, and the jobless rate stayed at 3.5%. That matches the lowest in 5 decades. Those figures could be enough to lead the Fed to raise rates by another 75 basis points to fight inflation. In Argentina, a man was arrested after pointing a gun at Vice President Cristina Fernandez de Kirchner and pulling the trigger. The gun did not fire, and the man was arrested. He was described as a Brazilian with a history of carrying weapons. The incident comes at a time at which Argentina is bitterly polarized after years of economic crisis and political infighting. Bloomberg's learned that Japan's SoftBank is planning to cut at least 20% of the staff at its Vision Fund operation. The world's biggest tech investor will slash a minimum of 100 positions. Earlier this summer, the Vision Fund posted a record $23 billion loss. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
To name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
I'm Kaylee Lines.
And I'm Damian Sassower. Join us each week on our brand new show, The Lineup. If you're betting on the Mets, it's a pretty good return.
We'll cover the latest trends in sports betting, the hottest matchups, shifting spreads, and the data you can't find anywhere else. It is crazy how much the money line has changed from the preseason to now.
Plus, expert insights from special guests.
The Eagles got a gem on their hands. I hate to say it because they're in the NFC East with the Giants.
Odds are it'll be your favorite way to stay in the game.
Catch The Lineup Fridays and Saturdays only on Bloomberg.
When you've had your fill of IPOs, ETFs, and CPI,
tune into The Lineup for some NFL, NBA, and MLB. Did you retire too early? I mean, look at some of these payouts.
I absolutely retired too early.
For the inside scoop on sports betting, catch The Lineup right here on Bloomberg.
Friday.
Why has Elon Musk said no to the car factory?
It's still in discussion. Let's see later the final result.
Do you think that by bringing people together, that is a way to solve conflict?
There must be communication, even if it doesn't necessarily resolve the problem. It is better to have dialogue than to have open conflict.
This is a conversation with President Jokowi of Indonesia.
Only on Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Last month's jobs report caught everyone off guard.
This is quite a surprise. Oh my, as Dick Enberg would say.
That is a wow statistic.
That recession talk just got a freezing cold shower.
Today, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
It's good news, bad news, good news.
They're walking that fine line.
We still have a large gap between jobs and workers, but at least we're moving in the right direction.
The market has 2023 wrong.
The August jobs report today on Bloomberg Television and Radio.
Donald Trump and the MAGA Republicans represent an extremism that threatens the very foundations of our republic. They live not in the light of truth, but in the shadow of lies. But together we can choose a different path.
An address to the nation by the President of the United States from New York City this morning. Good morning. With Tom Keene and Anna Edwards, I'm Jonathan Ferro. Bramo's going to be back on Tuesday. Futures unchanged on the S&P 500, the Nasdaq 100 negative by around about 0.2%, down 23 points going into payrolls a little bit later this morning. 2 hours and 12 minutes away, looking for something close to 300k. Yields unchanged, 325.75 on a 10-year. The 2-year's been creeping higher ever since Chairman Powell spoke last Friday, Tom. A brief breach of about 350 on a 2-year.
John, I want to go to the real yield here very quickly before Jack Fitzpatrick. What an explosion we saw yesterday in the inflation-adjusted yield out to 0.8042. Dare I say a positive 1% figures somewhere out there on the horizon. John, that changes your discussion this afternoon.
I couldn't agree more, Tom, and we're starting to get round to those levels that we hit in late 2018, when the credit market really seized up and the Fed had to back away. And most people agree that this is very, very different. And I think for anyone in the fixed income market, Tom, they've got to consider what that means for corporate credit.
John, have you been to Independence Hall in Philadelphia?
I haven't, Tom.
It is extraordinary. For those of you that haven't, it has been restored 14 times or whatever since 1780. It is really quite moving in what the National Park Service has done, particularly in piecing back together our belief of what the assembly room looked like as they pieced together the Declaration of Independence and the future of America. The scene last night for the President of the United States. Jack Fitzpatrick briefs from Washington this morning. Are we going to see more of this, Jack? Is the President going to dash to the first Tuesday of November with events like this?
Yeah, it sounds like it. I think this clearly was an attempt to establish a strong campaign message. Aside from what you've heard from Democrats on their legislative accomplishments, aside from the economy, the president has made it very clear that this is a significant focus. This wasn't. He did almost back-to-back speeches. His speech on Tuesday was pretty similar, followed by this higher-profile speech on Thursday, and it did stand out that he immediately named Donald Trump, which he had previously not been doing. He talked about the issues January 6th, but made it less Trump-focused. This was a speech about those issues, but also directed much more strongly toward Trump, and it seems to be something that President Biden wants to play up pretty significantly for the next couple months.
Completely unfair question, but to get us to the Sunday talk shows, you'll hear many of those on Bloomberg Radio. Jack, is this a president with the body language of considering a second term at his age, or is this a one-term president leading the troops to November?
It's hard to predict because he would not want to give any signs that he might not run again leading up to the midterms. That would not help him. It wouldn't help his party. But, he's going out there with campaign-style speeches that are at least quite energetic, looking at the one last night. So he is in campaign mode. He's not giving off signs that he's not going to run. But the concerns are there. You've heard even from Democratic lawmakers that they don't think he's going to run. So I wouldn't say that's predictive.
Jack, good to speak to you. Oil prices, gas prices have clearly been a big domestic issue. That takes on international context when you look at higher commodity prices in recent months. I note a red headline across the Bloomberg tells us that the G7 is set to back a plan to introduce a cap on the price of Russian oil. I know from a European perspective, there's been a lot of skepticism on whether a cap will work. How do you get the rest of the world involved? The US says the rest of the world can use that as leverage. Anything you can add on the domestic side of this, how this is set to play out domestically?
Domestically, on Capitol Hill, this is the kind of thing that there would probably be a lot of support for, especially considering what you just mentioned about the U.S. argument that even if this is not massively widespread, this agreement to limit the price of payments on Russian oil, then that would still have an effect on what other countries would pay because of how it factors into negotiations. Talking to lawmakers, seeing the action outside of just the administration, there's a lot of pressure to find whatever points they can to increase pressure on Russia. So domestically, this could be fairly popular, but that doesn't answer all the questions about the extent of how many countries participate in the international questions.
I think we're all trying to work out how this works in practice. Jack Fitzpatrick there, down in D.C. Jax, thank you. Hey, Tom, look, you mentioned it earlier with below $4 on gasoline. I think that's a massive improvement from where we were in the middle of June 13th, north of $5. And there was a fear. You remember that note from J.P. Morgan at the start of summer that maybe we could get through $6 a gallon on gasoline in America? Didn't get there, rolled over. $3.83 at the moment, Tom, on average.
I'm going to pick on the guy that I know best on this, David Rosenberg, iconic at Merrill Lynch years ago, and of course with his own shop up in Toronto. But what's so important here, John, is the media focuses on just emotional things of inflation, used cars, rents, housing. It's all many, many little pieces. And you got to parse all that out, and it may parse towards a disinflationary tendency. But John, does that get you from 8.9 down to 7, which is unacceptable, no question, down to 5? Or where after that is a huge debate.
You've raised the question, Tom. What happens if we settle down at 5? And where does that leave the Fed? Fed's on a raise and hold. I caught up with Daryl Cronk yesterday, and we've been talking about peak inflation, peak hawkishness for so long. There's a P word we need to discuss even more after last Friday, Tom. It's persistence. This Fed's going to get rates up there and hold them there. It's the takeaway of the last week for a lot of people. They could do a lot of damage too.
Well, they could. I mean, and the trends here, and we haven't talked much about Europe this morning because it's job day and that. But I'm sorry, the European dynamic, John, is factors worse.
Well, it's brutal, Tom. Stunning. I mean, the difference between the Fed and the ECB, both central banks are set to hike 75 basis points. There's a debate as to whether the Fed goes and drives this economy into a recession, Tom. In Europe, no one's even questioning that. It's just about how deep it's going to be, Tom. It's pretty messy stuff on the ECB into next week.
John, can I just digress as the president spoke at Independence Hall? I mean, I'm looking at him in the lights with Dr. Biden there. It reminded me of old White Hart Lane. And, I just think
Can you imagine if I said that, how offended Americans might be?
The Tots could do something to give it the majesty of Independence Hall.
Who are you playing later this weekend?
I haven't even looked. I'm still getting over West Ham tie. What Nate Shelley did to us, it's just unbelievable.
TK.
It's painful.
When's the third season of Ted Lasso out?
Anna, do you know? When's Ted Lasso out? I don't know.
No idea. Futures, down a 10th on the S&P on the Nasdaq.
Euro above parity.
Down about 1/3 of 1%. Just about, Tom. Yields, 326 on a 10-year. More on the markets up next with Sarah House on This Economy. This is Bloomberg.
into the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
Live from New York City this morning. Good morning. Down on the week, down on the session. We're down about 1/10% on the S&P 500. On the NASDAQ 100, down about 1/3%. Yesterday, just about getting a day of gains, but still a close below 4K. Michael Hartnett out of Bank of America out this morning with the flow show. That's his weekly note.
Yeah.
Pointing out that, Tom, they'd take a nibble at 3,600, 3,700. That's his first nibble.
Yeah.
It's not here. That's for sure.
Everybody's got an opinion on this. I'm going to stay out of that, John. I will say the VIX has been constructive. You'd think with the agony out there, John, we popped out to 30, 31, 32. No, that didn't happen. 27 level. And right now, with the better market yesterday, 25.46.
I don't think anyone's prepared to call this panic, Tom. That's for sure. Even after the steep losses of the last week, even after this move at the front end of the yield curve on twos.
Out there.
Every single day. I agree with you, TK. Trying to find a bull. Had complaints about that yesterday.
There's out there, yeah.
There's some
I had
bulls out there.
complaints too.
Marco Kalanovich over at JP Morgan. John Stolfus been another one at Oppenheimer.
Credit Suisse is optimistic. I think they're
Sure, Jonathan Golub has been, yeah. 350 on a 2-year, so we're above those kind of levels now. 349.85, just dancing around 350. Tom, before today, every single day since Friday, yields higher at the front end after Chairman Powell. I think the market got the message.
This is really important as people reset over Labor Day weekend. This is about 4 markets. It's not just about the stock market. We can focus, John, on Michael Wilson and others talking about earnings and challenges. We heard that from Steve Whiting. But I agree with you, the bond market's speaking volumes here.
And the 10-year as well, back at 326.
Yeah.
A lot of people got very comfortable with the idea. We've seen the high for the year. Yeah. They're starting to get uncomfortable right now. BMO's Ian Leon was on this show yesterday, and he said if we get to 350 on 10s, that's a great buy. So we'll see how much buying comes in as the yield pushes a little bit higher again today. I want to go over to Europe just briefly and talk about the dollar strength we've seen. Euro dollar in and around parity through much of this week, essentially unchanged. Today, firmer by about 0.5%, 99.97 on euro dollar. But it's really about that spread now between Germany and Italy. 230 basis points-ish through much of this week. 395 on a 10-year in Italy. Let's call it 160 on a 10-year over in Germany. So Badrish Apper and the team over at SocGen saying that spread could go as wide as 300 basis points, Tom. And this is the issue, I think, that a lot of people have got right now. Even if we go to, say, higher unemployment year-end for the Federal Reserve, they're not going to turn around and pull a U-turn.
Yeah.
That's the communication so far. And even if that spread blows out, even if we get a recession in Europe, the ECB is determined to go again. Citi out this morning, Tom, teeing up maybe 75 at the meeting next week, and perhaps even 75 again. And we're not talking about the Fed. We're talking about the ECB. But, Tom, the fact we're having that conversation is a major change from where we were.
Well, I like what AEP
just
did
month
the
ago.
Telegraph today, John, on Italy, where he just took it from when Draghi stepped in for public service and how much it's deteriorated from the technocrat taking over.
TK, it's easy to keep a lid on these kind of things when inflation is low. Inflation's not low, and rates are going the other way. Central bank's not there in the same way anymore. The Fed for the equity market, the ECB for the bond market.
I'm going to go to sterling, rather, 115.60, maybe a little bit of a breather here. You looked early morning when I first took a look at the phone, folks. It's sterling to 114, unimaginable. Yen 140.35 also gets my attention. We're bouncing around between these incredible markets. Of course, Anna Edwards watching the politics of the United Kingdom. And, of course, it is Jobs Day in America. So stay with us on this Friday into the long weekend. Sarah House briefs us now, senior economist at Wells Fargo. Sarah, let me start with a stupid question. What's your NFP number this morning? Are you at 300 or are you moving around?
So we've actually bumped our number up a little bit. We're at 375, and I think part of that reflects the fact that we did see a really strong ISM manufacturing number, and also just as we sit back and think about some of the structural elements we're seeing right now, we're still seeing a lot of new business formation, suggesting that the birth-death model boost is still pretty strong.
Jim Glassman of J.P. Morgan, iconic, was heated yesterday that it's better than the gloom crew says. Wells Fargo shares that heritage with the work of John Sylvia and Mr. Bryson and all the other people you have. Do you think the gloom crew is wrong on the American labor economy?
So I think directionally the consensus is right. I think we are seeing signs of the labor market cooling. I think what's been tricky is to fine-tune the degree of that. And what we've seen over the past few months from the payrolls data, from some of the more recent data on things like jobless claims stabilizing, the still very elevated rate of job openings, the fact that we really haven't seen quits come down at all, is that there's still a lot of resilience in this labor market. There's still very durable demand for workers, and you have to think about what that means for the income trajectory, even in this high inflation environment, is if you have strong hiring, you have decent income growth even against these high price movements.
Sarah, forgive me for not looking ahead to 8:30. I want to look back to 528,000 a month ago. I'm still blown away from that. Sarah, what was that?
So I think in part it was perhaps the seasonal still particularly difficult in July, and then going back into this birth-death model factor, we had the contribution for July was more than twice what it is over the past 5 years, and so that was coming at a month when the seasonals actually expected to decline. So that really gave a boost there. We think that overstates the underlying run rate of payroll growth right now, but I think even accounting for that, we're still looking at very, very strong job growth, consistent with the elevated hiring plans we continue to see from things like the small business survey.
Sarah, how sensitive do you think the Fed is on September 21 to this data point and CPI on the 13th? I just wonder how important it actually is, given that the chairman has basically told us that the story's much bigger than that.
Yeah, so I mean, I think it still plays a role in whether it's 50 or 75 for September. I think it will tilt the scales. I don't think it's going to settle the matter. We'll leave that for the inflation numbers that we get out on September 13th. But I think when we look at this report, there is inflation data in this report with average hourly earnings, and I think that's been one of the perhaps underappreciated aspects of the inflation outlook right now is, yes, we're seeing some relief in supply chains. We're seeing commodity prices come down, but that only gets you so far if you still have elevated wage growth in terms of bringing inflation back down to 2%. Right now, we're still seeing average hourly earnings, ECI, both running around 5% annualized. And even if you give some generous assumptions about what the true trend in productivity is,